All right, go ahead and bring the meeting to order. As we always do, I'd like to start off with a moment of silence for for those who have passed and paid the ultimate sacrifice. So if you join me, I thank you.
The conference has been muted.
Okay, thank you. All right, our first, we have a pretty full agenda today, so we're going to kind of keep this meeting moving this morning. The first thing we're going to start off with is our minutes from July 14th, and to get those approved, do I have a motion on the table to approve the minutes from July 24th? Have a second? Discussion? All right, motion passes. Okay,
Good
our
morning.
next one.
Sorry, this is Mark Johnston.
It sounds like Mark Johnson. Hey, good morning, Mark. Thanks for calling in this morning. We're going to go ahead and move to our next one. We made a movement from our board elections earlier this morning to get this taken care of. So I'm going to go ahead and start and read it per our policy. We do have a board election for our chair, vice chair, and employee representative. Board officer elections. The board's operating policies included in the materials state that every 2 years, board member elections are held for chair, vice chair, and an employee representative for the administrative committee. Anyone is welcome to attend administrative committee meetings that take place 1 hour prior to the start of the regular board meeting. The administrative committee serves by reviewing the agenda prior to the meeting, handling performance evaluations for the executive director, and other issues as they arise. Today we have the option of making a motion to connect both the nominations and elections for this period. So the first one will be for chair. Do I have a motion on the table for the position of chair? Okay. Okay. We have a second for Dennis Lawson for the chair of the Left 2 board. Any discussion? Okay. All those in favor?
Aye.
Aye. All those
Aye.
opposed? All those opposed? Okay, motion carries. Congratulations, Dennis.
Second.
Any discussion? All right, all those in favor?
Aye.
Aye.
Train's running.
Excuse me, Jason.
Yes.
I can't hear other people when they're making motions or seconding. Maybe
Okay.
it's because they don't have their microphones on, but I'd like to be able to hear.
Sure. So we'll go ahead and we'll do that again. So a motion on the table for vice chair.
I'll make a motion to have Jason as the vice chair.
And I second it. McElligott seconds.
Okay. Discussion? I'm sorry, actually, all those in favor?
Aye.
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 All those opposed? Okay, motion for vice chair for Jason Granneman is passed. Congratulations to me. And so, all right, motion on the table for employee representative.
I would move odd day.
Okay, Mark Johnson moves for Ade. Have a second?
I'll second.
Second by Tarina. Okay, discussion? All those in favor?
Aye.
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 All those opposed? Okay, motion is carried for employee representative for Ade. Congratulations. All right. With the elections done, we'll go ahead and move on to getting our meeting started. I'm going to go ahead and turn it over to Steve for our first agenda item. Thank you, Steve.
We've got some 3 actuarial presentations coming up. The first one has to do with the recommendation from the Office of the State Actuary regarding long-term economic assumptions that are adopted by the board. And with that, I will turn it over to Matt and Mitch for their presentation.
Thank you, Steve. For the record, my name is Matt Smith. I'm the state actuary. With me is Mitch DeCamp. It's my pleasure today to present the results of our most recent economic experience study. For those of you who are less familiar with this process, we look at our assumptions every year to make sure they're reasonable. Every 2 years, we make a formal recommendation to both you and the Pension Funding Council about the economic assumptions. Today, we're just going to be going over the highlights of this most recent report, and I believe the link to the full report was included in your meeting materials. I'm just going to cover a couple of background and context slides, and then Mitch is going to walk you through the specifics, and I'll stay to answer questions. First thing I wanted to really clarify before we get into too many of the details is the purpose and measurement period, because they're very important for the assumptions that we're bringing forward to you. So actuaries set assumptions consistent with the purpose of the measurement. So in this particular case, we're talking about setting long-term economic assumptions for funding the pension system consistent with the state's funding policy and your funding policy. And one of the really key things to keep in mind is that we are setting contribution rates on anticipated investment returns. The other key thing is the measurement period, or the forecasting period. So not only are we thinking about why are we setting these assumptions, for what period? So these are longer term assumptions. We're not trying to estimate next year's return or the return over the next 2 years. In many cases, we're looking at returns that are going to be over 25 years or more. And the measurement period does vary by assumption. So just a reminder there at the end, if you have a different period or measurement in mind, we would be setting different assumptions. And one last context slide, just to sort of the importance of all this. Why do we care about this? I mentioned investment returns. Let's put it in context here. We're setting economic assumptions to fund this. This graph shows you the projected benefit payments for every current member in LEF 2 over their lifetime. Your current actives who are going to ultimately, if they retire, earn a benefit. The people who are currently retired and receiving benefits, they're survivors, they're beneficiaries. The scale on the left, the axis on the left there has been rounded. It's actually 500 million increments, so it's 0, 500 million, 1 billion, 2.5 billion, and so on. So you're currently paying out annual benefits of around 300 million for your current population. Just that current population, and not recognizing any new people coming into the system, around the 2050s, you would peak out at about 2.5 billion in annual benefit payments, trending down. So this is a significant amount of benefit payments, and the assumptions that we're setting, even small adjustments to the assumptions, have a significant impact on the funding of your plan. So I just wanted to put that in context for you. And with that, I'm going to hand it over to Mitch to walk you through the specific analysis on the 3 economic assumptions that we looked at.
All right, thank you, Matt. Mr. Chair, members of the board, for the record, Mitch DeCamp, Office of the State Actuary. So I'm going to start out covering the assumptions we looked at in this study, and then a little bit on how we use them. So the first assumption we looked at in this study was inflation, and we use this to model post-retirement cost of living adjustments, or COLAs, and these are based on changes in the Consumer Price Index for Seattle, Tacoma, and Bellevue. The key note here is that this inflation is Washington-specific inflation. We also set a national inflation assumption, but we add a regional adjustment to get it back to Washington-specific. The other piece we use inflation for is a building block for the other assumptions, and I got a slide coming up that's going to show you exactly what that means. The next assumption we looked at was the general salary growth assumption. This is used to project member salaries into the future. Salaries are a really important part of projecting member benefits, as well as projecting payroll, because contributions are taken as a percentage of payroll. The last assumption is investment returns, and this is our assumed return on plan assets. We use it in our model to determine today's value of future benefit payments and salaries. So one more thing before we get going too far here. So we developed these assumptions as a consistent set of economic assumptions, and we recommend reviewing them as a set of assumptions. So no cherry picking, please. So this slide shows what I meant by the building block approach, and it really kind of walks it through with actual building blocks. And it all starts with inflation. So starting at the bottom left part of this slide with inflation, inflation is represented by this dark blue rectangle. So we first set this inflation assumption, and then it forms the base for the general salary growth and for the investment return assumption. So moving over to the general salary growth assumption, we start with that inflationary base. We layer on top of it the real salary growth assumption. Adding both of those together gets us to the total general salary growth assumption. Same process for investment returns, starting with that inflation base, adding on top of it the real rate of return. Both of those together get us the entire investment return assumption. So you're going to see today as we're going through the slides, this is going to be how we're going to tell you the total recommendation, but as well break it up into the building blocks. And because it all starts with inflation, that's the first assumption we're going to talk about in a little bit more detail today. This slide is a kind of a high-level summary slide, walk you through the data, the forecasts, the recommendations. I'm going to go through this summary slide, and then I'm going to look at some of the data and the forecasts a little bit closer. You weren't going to get out of here today without looking at a little bit of data with me. So starting with the historical data, inflation has remained low for the past few decades, and inflation in the Seattle-Tacoma-Bellevue area has consistently outpaced national inflation. Now, I mentioned a couple slides ago, we first start out setting a national inflation assumption and then add a regional adjustment. We do that for two reasons. National inflation is used in other parts of our model, but also there's a lot of other experts out there who project national inflation. So it gives us a lot of other comparison points about where we're landing with national inflation and how we study the assumption. So in terms of those forecasts, we're seeing that short-term national inflation forecasts remain low, and long-term forecasts are typically higher due to uncertainty over longer forecasting periods. Really what it comes down to is the recommendation, and we are recommending no change to the total inflation assumption of 2.75%. The board adopted 2.75% as the inflation assumption based off of the 2017 economic experience study. So no change in our recommendation from the last study to this study. And that 2.75%, it's built of a 2.35% national inflation and a 0.4% regional adjustment. So while we didn't change the total inflation assumption, we did adjust the components. We decreased that national component and increased the regional adjustment. So now looking at a little bit of the data, this slide shows the last 30 years of national inflation. And kind of the key here is that it's really been quite stable inflation over the last 30 years. There's a couple points around the recession when it dips negative and a couple points early in the period when it's 4 and 5%, but it's really bounded by about 1.5 and 3.5% inflation. And this graph may not look super stable, but comparing it to other historical periods, this is really remarkably stable, especially when you compare to periods of the 70s and 80s where inflation would spike and be double digits. It's really, really stable. There's a couple reasons for this. Could be the evolving economy, but also could be the Federal Reserve monetary policy. Federal Reserve is targeting a 2% inflation assumption, or an inflation, actual inflation year over year. And they started managing this throughout this period. And we believe due to that target is the reason that inflation is one of the reasons inflation has been so stable. So considering this history, considering some other economic estimates I'm not really going to touch on today, this Federal Reserve monetary policy, we moved to lower our national inflation assumption from 2.45% down to 2.35%. So how does that compare with other experts? This slide shows a comparison of our new national inflation assumption in red compared to a variety of other experts. And they come from a bunch of different sources, public, private. I'm not going to go through them all, but they're typically big institutions, Congressional Budget Office, Social Security Administration, places like that. Key takeaway here is that our assumption is kind of shooting right through the middle of all of these other experts. If you were to take our prior assumption of 2.45%, you can see it would definitely be on the higher end compared to these other experts. So we're really happy with how this new assumption lined up compared to how everybody else is approaching future inflation. Last piece of inflation is that regional adjustment. And this graph shows the difference between Washington inflation to national inflation. So all the points above this zero line are years that Washington inflation has outpaced national inflation. And then the opposite is true for points below where national inflation have been higher. And over this 30-year period, you can see that we have many more data points above that zero line. So Washington has consistently outpaced national inflation. One other kind of technical note on how this could look in the future: the Bureau of Labor Statistics is the one that is responsible for measuring this year-over-year Washington-specific inflation. They recently changed their index from Seattle-Tacoma-Bremerton to Seattle-Tacoma-Bellevue. And when they did that, they removed some of the lower-cost counties from the index. And they're going to be focusing this index more on the city areas of Seattle, Tacoma, and Bellevue. And given that change, we expect that future inflation measured by this index could be higher because those areas typically experience higher levels of inflation. So given that index change and given this long history of Washington inflation greater than national inflation, we increased that regional adjustment just slightly from 0.3 to 0.4%. So, little recap here. No change to the total inflation of 2.75%, but just some tweaks to those underlying components. On to the second assumption, real salary growth, and this is all salary growth above inflation. For the historical data, before I go too far into this, I want to briefly touch on how we treat salary data in our model. So we divide salary data between economic salary data and economic salary growth and demographic salary growth. So economic salary growth, this is salary growth that all active members across all the retirement systems are going to receive every year. Demographic salary growth is going to capture things like differences in plan, like PERS members versus LEF members, and where members are at in their career. And we study that second piece, that demographic piece, in the demographic experience study, which Michael's going to be talking about up next. But for now, this is the economic experience study, so we're studying that economic salary growth, and because it's the same across all members, we aggregated all data across all Plan 2-3 member data. So we studied it across all plans at once. And when we isolated that economic salary growth, we saw that it was consistent with our current assumption after considering the impact of outliers. And I'm going to talk about those outliers here in a couple slides. For forecasts, so national forecasts are a little bit different. So they include both the economic and demographic salary growth factors in one measure, which means it's kind of an apples to oranges comparison when we compare what we do with real salary growth compared to what national forecasters do. However, we can use those national forecasts to see how have they changed. Are they expecting something different in real salary growth? And so when we compare those forecasts from 2 years ago to today, we see that they are virtually unchanged from 2 years ago. So seeing those forecasts as being unchanged, seeing our historical data as pretty close with our current assumption, we are recommending no change to the real salary growth assumption, which also means no change to the general salary growth assumption of 3.5%. Again, the board has already adopted that 3.5% assumption based upon the last economic experience study. So I want to touch on go for it.
I'm sorry, this is Mark. I have just a quick question for you on that.
Sure.
Because this always is interesting to me, is do you find that there's a difference or a statistical or a material difference between the demographics of the Left 2 plan and either national measures or other economic measures within the state of Washington with general salaries? And I only say that because I'm interested in if it's a consideration for you based on our collective bargaining laws in Washington, the difference between left members and interest arbitration and other groups that don't have the ability to go to interest arbitration over salary when contract negotiations.
So, Mark, when we set that demographic salary growth, we look at a long history of the demographic salary growth for LEF and then the demographic salary growth for all PERS members. So we don't specifically compare that demographic salary growth to say private sector employees. We're really focusing on the members of LEF or like the members of PERS when we're setting that demographic piece. Does that help answer your question?
Yes, but do you find a difference historically between salary growth in non-interest arbitration groups, or between those groups and between interest arbitration groups, or does that even factor into what you're measuring?
Mark, this is Matt. I'm going to jump in. I really appreciate your question. It reminds me something we can clarify up front. We don't receive the source of the salary increase in our data. When Michael talks to you later about the demographic experience study, we also don't know like why someone retires. We just know that they retired. We get a record that they retired. We look at salary data, but we don't get a salary record that says this person got a promotion. This person got an increase because of collective bargaining. This person got a step increase. So our model really can just put it into two sources, as Mitch mentioned, economic or demographic. So yeah, it's conceivable that you could have different economic salary growth across the systems, but for our model, it doesn't really matter because in the end, we're modeling total salary growth. If you're low on the economic component, we're going to assume higher demographic and vice versa. So until we get more granular data, and that may not happen in the near future, we really aren't able to specifically model the level of economic increases the way I think you're thinking.
Okay. Nope. Very good. Thank you.
Yeah, I think I'd just like to follow up a little bit on that. So, but some of the recent contracts that were signed, actually in the last 5 years, I guess, are probably way above these. So how do we factor that in? We recently did a study of, especially for our police officers, how much they were making 6 years ago, how much the same position is making today. And the growth is really, really high. So how do we go back and factor that into this salary growth?
Well, we're looking at total salary growth. So this is one of the confusing parts of presenting this when it has the two components. So we're always looking at total salary growth. In our model, we really have two choices. You make an assumption for the economic component, you make an assumption for the demographic component. We study them separately. We also look at total salary growth. So we are monitoring total salary growth. Every time we do an actual evaluation, we look at the assumed salary growth, the actual salary growth. And if we see outside of these studies, if we see that our assumption is consistently falling short, we bring adjustments to you, and we would bring it into the actual evaluation if there's an emerging salary growth that's significantly different than what we assume. The other challenge here is that these are long-term assumptions, so there's going to be a little wiggling around any mean. So we have to make sure we're not overreacting in either direction to salaries, because there was a period of time when salaries were significantly below our assumption, especially after the Great Recession. Now we're seeing a little bit of a bounce back. So it's there's definitely some art here in addition to the science, some judgment involved.
Thank you.
So here's an example of kind of what we're talking about, of how we divide that salary growth up. This slide shows a comparison of a 9% salary growth for a member under our measure and then under that national measure. So starting with our measure, that bottom block is inflation. And on top of that, that brown strip there is that economic piece of salary growth. That's the one that we're studying right now in this study. And then on top of that is that demographic piece of salary growth. We call that service-based salary increases. In comparison, this national measure, you have inflation, and then everything above inflation falls into that economic piece of salary growth. So we do have a little bit more targeted approach with how we are applying our assumptions in our model. And you can see this is why we can't directly compare what the national forecasters are doing with how we are studying our economic piece of salary growth here. So when we did look at our Plan 2-3 data, we saw that real salary growth was consistent with our current assumption after adjusting for those outliers. This graph here shows average salary growth over the last 10, 20, and 30-year increments. The dark blue bars are all data, and the green bars are after an adjustment. And that adjustment is adjusting some of the data around the Great Recession. The Great Recession, really hard on salaries, actually resulted in negative salary growth. So we adjusted some of that data because we don't think that's the most predictive of salary growth experience over the next 15 to 20 years. So we set our assumption based off of the green bars that you see here, and looking at these green bar averages over the last 10, 20, and 30 years, we feel that our current assumption of 0.75% is reasonable. So we're almost there. Last assumption, investment returns, starting with our summary slide again. Historical data, the average returns are generally at or above our assumed return, depending on the period selected. For forecasts are based on the new capital market assumption and asset allocation from the Washington State Investment Board, or WSIB. And WSIB expects the same median 15-year return as 2 years ago. Now, we applied our professional judgment to extend WSIB's return expectations beyond 15 years. WSIB sets their assumptions for use over a 15-year period. We go beyond that to that 20 or 25-year mark, so we had to make some professional judgment calls when we did that. We also made adjustments to ensure consistency within our set of economic assumptions. So we have investment returns built of inflation as a base. Want to make sure that investment return assumption is consistent with that inflation base. What it comes down to is the recommendation, and we are recommending no change to the current assumption of 7.4%. And that 7.4% built of a 2.35% national inflation and a 5.05% real rate of return. So looking at the historical data, we did historical average returns over the last 5, 10, 15, 20, and 30 years. And we see that almost all of these historical periods are above the currently assumed rate of 7.4%. Really speaks to what an excellent job the State Investment Board has done investing the assets of the plan. Couple things I want to impress on you as you're looking at these average returns. One is to be really cognizant of the period that we are looking at and considering market cycles when we're looking at average returns. So a market cycle is defined as a bear market, a recovery, and then a bull market. And a good example is the current market cycle that we're in. This market cycle started in 2008, 2009 with the bear market, large losses. The recovery was the next 2 years. Returns were 16 and 21%. So big recovery. And then the bull market is what we've been enjoying for the last 8 years. And then I can tie that into what this past 10-year return looks like. 10.5% return, really high because it only includes the recovery and the bull market. It excludes the bear market of 2008, 2009. And if we did a past 12-year average return, that 10.5 drops to 6.25. So it spins a very different story depending on the period you're looking at. So we're very happy with these returns that we're seeing right here. Just know that the average return can be very swayed depending upon the period that you're looking over. Last thing I want to touch on this slide is economic conditions of the past that may not repeat in the future. If you go back 30 years, that past 30-year return, 8.8% return, very strong return over the past 30 years. The economic conditions that created those returns may not occur in the future to create those returns again. A good example that we looked at for this was interest rates measured by a treasury note, and we looked at a 10-year treasury note. If you buy a treasury note today, yields about 2.3% annually for 10 years. A 10-year treasury note 30 years ago yielded over 7%. So comparing that 7% guaranteed treasury note return with this 8.8% average return, you can see how much easier it was to attain high returns in the past. And because the economic conditions of the past are typically very different than they are today, we tend to not rely on historical returns to set our future expectation.
I can just add one point. Not necessarily that the returns are easy to earn, but the amount of risk that you're taking to earn that return is dramatically changed, right? If you could get a treasury, 10-year treasury 30 years ago at 7%, right? We got 8.8 over the 30-year period. Now you're talking about a 10-year treasury, north of 2%, wanting to hit a 7% return. So yeah, we don't invest 100% in treasuries, probably never will, but that's the level of additional risk you have to take in order to hit your target.
So before we start looking at our expectation for the future, I want to take a quick second and look at asset allocation, because it's really important. So as of the last valuation, Left Plan 2 had about $12.5 billion of assets on a market value basis. And this pie chart here shows you how that $12.5 billion is invested. The keynote here is that public pension plans don't all invest the same way. And in fact, the Washington State Investment Board invests a higher allocation to private markets than their peers. And this higher allocation of private markets typically leads to higher returns, but higher standard deviation of returns. So when you're comparing return expectations for Left Plan 2 with other pension plans from around the country, or even from a typical investor portfolio like a 401k, just understand that the assets are likely invested differently, and how those assets are invested are key to understanding the return expectation. So now
Sure. Mitch and Matt, both when you're talking about the investment policies, these are the investment policies of the State Investment Board, the private equity is an issue because of the amount of monies that we have to invest. We get probably the 0.1% of 1% deals that a lot of people aren't allowed into. And that is where our investment board has done an excellent job on the investments. The real estate portfolio, if I'm not mistaken, is somewhat internal. And so they're able to really, really control the costs of those things. And I'm not trying to tout the State Investment Board for any other reason other than they have done an excellent job. And I think they're coming up on a retirement of Gary Brubaker. And Gary, when he got here, has always been knocking it out of the park. He's always been stable, and he's got a great team over there. And that's why the investments are what they are. And when we talk about the Left 2 money, it's not only just the Left 2, it's PERS, it's all monies that are invested. They've done a great job. So I just wanted to give them a little bit of a shout out because they have done such an excellent job, and I am on pension, and I like that. So thank you.
Excellent comments. So now talking about the expectations for the future. So taking that asset allocation we just looked at, WSIB then takes they have assumptions for how all those asset classes are going to perform, standard deviations for how those returns could look differently, and they run thousands of simulations, and then they give us the results of those simulations. And what you see here in this table is the median return. And the median return is the return that splits half of simulations fell above that number and half of simulations fell below that number. And what we see when we look at that median return is it was 7.36 in the 2017 study and 7.36 in the 2019 study. And the reason that's important is that is the measure we focus on when we set this assumption. But we know that 7.36% median return is built of assumptions. So we wanted to take a look at how that median return could change around when we change around the underlying return expectations for the two largest asset classes that WSIB invests in, and that's private and global equities. Together, they constitute 55% of the target portfolio, so a really large portion of the investments. So we changed that underlying expected return by plus and minus 1%. We did that independently for private equity and then for global equity. And you can see there's a pretty sizable change in the median return of the simulated median return. And that really just gives us a sense for how sensitive that is to changes in those underlying asset expectations. Couple notes on private and global equities, kind of what they are, because I think it's important to understand what they are. Private equity, as its name implies, it's private markets that are not listed on public exchanges, not easily accessible to most individuals, typically requires large investments to be a part of, because it ranges from things like initial capital startups to leveraged buyouts of mature corporations. On the other side of that is global equities. This represents shares of U.S. and non-U.S. corporations that trade on public exchanges. You can think about this as going out and buying shares of a company or investing in an index. So different types of assets here. So how did we land on the return recommendation? This slide kind of outlines our process. We've already talked about 1, 2, and 3 up here. That review of the historical data was 1. That review of the simulations was 2. We have some notes under them as well that just kind of summarize my points. And then number 3 was the slide we just talked about, and that was the review of the simulations with those different return expectations. So now we're on number 4, make adjustments. And the 2 adjustments we made were that we increased the returns to account for higher OSA inflation assumption. And the second adjustment we made was a decrease to the returns for lower expected long-term private equity returns. And I know what you're thinking. Tell me more about those adjustments. And so I can do that. The inflation adjustment, we'll start with that one. So WSIB assumes a lower national inflation assumption for a shorter 15-year time horizon. We assume a higher national inflation assumption for a longer time horizon. So we go out 20, 25 years. And so we did an adjustment of 0.15 percentage points to ensure our investment return assumption remains consistent with that underlying inflation assumption. For the private equity adjustment, WCIB assumes private equity returns will exceed global equity returns by 300 percentage points over the next 15 years. And we think that's a reasonable assumption for the next 15 years. But again, our time horizon, we go out 20 to 25 years. We've seen the continued evolution of the private equity market over the last 10 or 15 years, more people joining in the private equity market, vying for private equity investments. So we expect lower private equity returns beyond 15 years due to increased competition and efficiency.
And we did consult with the State Investment Board on this piece. And a little bit of historical context, too. I think there was a time, and Pat, you may remember your time on the State Investment Board, where I think the assumed premium was 500 basis points. So it's been working its way down as that market is evolving. And I think this is a modest adjustment to that premium when you reflect it beyond 15 years, coming down from 300 to 250 basis points. Still material, but that's all we're really doing is just projecting this into the future over a longer time period.
So this is what it looks like for the investment return assumption in the actual numbers. So we're starting with that 7.36% median 25-year return. We added 0.15% for the higher inflation assumption, subtracted 0.1% for our lower expectation of private equity returns, gets us to 7.41%. Our assumptions are never that precise, so we recommend a long-term rate of return assumption of 7.4%. which is the same recommendation as our last study 2 years ago. So a summary of the long-term economic assumptions, the current assumptions, and our recommendation. As you can see, all the current assumptions match, all the current assumptions for Left Plan 2 match the recommendations developed in this study. And so at this time, we are not recommending any changes to the economic assumptions for the board.
Thanks. Kind of curious. It looks like the national trends. I'm going ahead one slide. I think are coming in around 7.25. Where is that? Has that moved over the last couple of years? Where are we at on that?
It's been coming down pretty significantly since the Great Recession. For context, NASR stands for National Association of State Retirement Administrators. The median was 7.38 1 year ago, And I don't have the number here, but I'm going to, speculate that probably, 10 years ago, it was probably closer to 8% as the median. And there's some slides in the appendix that break this out by some of our peer states, and there's a distribution as well. But yeah, folks are moving down. I think it makes sense. And I think just to reiterate what Mitch said, why would ours be higher? Because we have a higher allocation to private equity. I don't think we're the largest, but we probably are pretty close to having one of the largest allocations to private equity across the country. So I think that can support a higher assumption than our peers. They might be, for example, only 15% in private equity, and we're 23. That's a material difference in how we're investing our money. Doesn't mean we're guaranteed to get that return, but I think you can justify it based on what we're looking at and what that portfolio can produce in those areas.
So with that, I think we are happy to answer any other questions you may have.
As part of benefit improvement plan, I think there's some discussion about changing the multiplier. So how would that affect all of this information if the multiplier for the retirement plan were to be changed? How would that affect this?
Sure. If the multiplier changed for Left Plan 2, I don't believe it's going to change these economic assumptions. These are kind of long-term economic assumptions that we expect, how we expect the economy to develop over the long run, and how the benefit provisions of the plan change are not going to impact these economic assumptions.
Although one of your PowerPoint talks about the total cost over so many years or something like that, where you were talking about $109 billion. So wouldn't that change?
If the multiplier were increased, it would change our expectation for future benefit payments. So benefit payments would be increasing because the plan is providing for larger benefits, a legislative change or a board change. So that wouldn't be an economic source for why we think benefits are going to be larger. It's not because of higher inflation. How it would impact our work, I agree with Mitch, I don't think it would necessarily change what we think is going to happen to inflation or general salary growth, but the plan's going to have to pay out higher benefits. The plan might need to adopt higher contribution rates depending on how it all compares. And we'd look at the cash flows. That's probably the one direct connection I could see. If the cash flows change dramatically and the portfolio had higher liquidity needs, it's possible, not very likely, that maybe the investment returns would need to account for that. But that's the only connection I can see for these economic assumptions is, could it have some impact on the investment return because you're paying out larger benefits?
Thank you.
Quick question on earlier in the slides, you were making some assumptions about inflation on a regional level here at Micro. Why did you pick Seattle, Tacoma, and Bellevue versus Seattle, Tacoma, Spokane, Seattle, Tacoma, Everett, somewhere in the corridor? Is there a demographic allocation that's a representative sample of the state? Why'd you go that direction?
So the index that is available is maintained by the Bureau of Labor Statistics. We're not able to choose that index. That's the only index that's available, and that's the index that's used when post-retirement cost of living adjustments are calculated. So we wanted to make sure that we lined up our assumption with what is actually going to be used to calculate members' benefit increases in the future.
Fair enough. One follow-up on the inflation projection. You're projecting 2.35. Why State Investment Board at 2.2?
That's primarily due to our longer time horizon. So we have as you can see with this slide that compares all these experts, typically as inflation forecasts go out longer, they typically get higher. Inflation is generally projected to remain low in the future, and when you have a singular point assumption like the State Investment Board and like us, that lower inflation in the near future is going to bring that point estimate down more. Whereas when we go out farther, we think that long-term inflation is going to be higher, raises that point estimate higher up.
Fair enough.
Any further questions? All right. Thank you, gentlemen.
Thank you.
Thank you.
In addition to the economic experience study that the actuary's office does every 2 years, they also periodically do a demographic experience study. Matt talked about that in his presentation, and here today to give a preview of the results of the most recent demographic experience study is Michael Harbour from OSA. And with that, Michael, I'll turn it over to you.
I think I hit the wrong button. Thank you. Sorry. All right. Good morning, Mr. Chair, members of the board. For the record, Michael Harbour, actuary for OSA, here with a preview of the demographic experience study. So for today's presentation, I'd like to start with a brief overview where I'll answer the question, what is a demographic experience study? And also outline the approach to our analysis. Then I have a quick status update as to where we are at in the process. From there, I'd like to take you back to your high school social studies class and look at a bit of a historic illustration, and then I'll show how that visually connects to our demographic experience study assumptions. Along the way, we'll also kind of look at which assumptions were studied, along with a few highlights. Lastly, we'll wrap up with how contribution rates are impacted when we make changes to these demographic assumptions. Of course, we'll close with a few next steps, but did want to mention that this is an educational presentation, so there is no action required by the board. So at its core, a demographic experience study starts with a review of historical plan experience. And in this case, we're mostly focused on the behavior or choices that the members make within the plan itself. This is quite a bit different from the economic assumptions that are typically based upon the larger economy. So at a minimum, we will review at least 6 years of historical experience data. Often we'll look at longer histories, upwards of 12 or even 30 years of experience, depending on the assumption that we're studying. And when we look at this data, it usually tells us what happened, but like Matt mentioned earlier, it rarely tells us why things happened. So another quick example is you have members who may stop working after only 4 years of service. Another group might stop working after 5 years of service. And there's a big difference there because somebody could earn a vested pension or not, but we don't get any survey results or anything like that to tell us why people made certain decisions. So then we'll take a look at that actual experience data and compare it with our current set of assumptions. And at that point, we may make a determination that a change to our demographic assumptions is necessary to better estimate future plan experience. We'll, of course, take into consideration a variety of factors, including how might the Great Recession impacted member behavior. We'll also note if there were any changes to the plan design, for instance, benefit improvements. At that point, we'll apply our professional judgment and evaluate our expectations for the future to select a preliminary set of demographic assumptions. And really our goal here is to ensure that the assumptions remain a reasonable estimate of future plan experience, ultimately for purposes of adequate pre-funding. So here's that quick status update. First and foremost, I want to say it's truly an honor to present this on behalf of the entire office. We started this work over 2 years ago in some initial planning, and thus far it's comprised over 3,000 hours of staff time, a very significant investment. And as a quick reminder, this is analysis that we perform every 6 years. So at this point in the process, we have selected a preliminary set of assumptions, but they are subject to change. We have an external actuarial audit that will take place next year. So for today's presentation, here's the major assumptions we'll focus on. We'll look at rates of termination, or how long people work. We'll also look at retirement experience along with disability and mortality. And to a smaller degree, I'll briefly touch on a component of total salary growth, like Matt and Mitch mentioned, along with a few miscellaneous assumptions. So here's that historic illustration. It may look pretty familiar to some of you history buffs out there. And what it's showing is Napoleon's march on Moscow during the War of 1812. And let me try to explain it in a little bit more detail here. So starting on the far left-hand side, you see a thick beige bar. The thickness of the bar here represents the number of men in Napoleon's army. So he starts out with 422,000 people and begins his march towards Moscow, moving from left to right on the graph. Along the way, you can see a couple of factions kind of splinter off and go and tackle different regions. But by the time they get to Moscow, there's only 100,000 people left in the army. At which point, we transition down to the thick black bar, where they start making their return trip home from right to left. And along the way, they encounter quite a few challenges. They got to go over some rivers. You can also see some thin black lines that extend down from that black bar. And that shows the winter temperatures that they incurred, which were as low as negative 30 degrees. And by the time they got all the way back home, there were only 10,000 people that remained in the army. So what I'd like to do next is take the spirit of this graph, specifically this concept where the thickness of the line represents the number of people at a point in time, and create a visual parallel to the state's pension systems. However, this exercise will be a little bit different. The chart about Napoleon's march is a depiction of events that occurred in the past, while the pension graph I'll show you next will utilize our demographic assumptions to estimate what we expect to happen in the future. Along the way, I'll also share some takeaways from our demographic experience study and describe how that graph is expected to change under a new set of demographic assumptions. With that in mind, here's a graph where the black bar represents 100 hypothetical left to new hires. And for purposes of this illustration, I assume that they were age 30. So over the first 5 years, this is where our termination rates start to kick in. And we transition from 100 original left to members, and the number that are still working at the end of that 5 years is only 80 of them left. That 20 is in that red shaded region, and these members, they didn't work 5 years, so they don't have a vested pension. So all they would receive back is their contributions with interest. Over the next 15 years, we still see members continuing to stop working. These are members who work kind of a partial career in the system, and that's represented by the blue shaded region. That's about 15 people. So let's step aside for a second and talk about the demographic experience study as it relates to termination rates. So what we observed historically is that members of Left Plan 2 have left service at lower rates than our previous set of assumptions. So how does this graph change? In aggregate, between these red and blue shaded regions, when we incorporate our new termination rates, the size of those gets a little bit smaller overall. Then over the next 20 years, we start to have members leave and through a service retirement. That's represented by the green shaded region. And that's about 55 people out of your original 100. So a significant portion are earning that kind of service retirement, more full career type benefit. So again, what did we see with the demographic experience study? In this case, members are working later in life than prior generations, generally speaking, which would take this green shaded region and just gently push it out a little bit into slightly older ages. Also wanted to touch on disability. On the graph, there's a really couple thin shaded regions. We got the gold and purple sections. That's representing members who incurred a pre-retirement death or disabled. And this is both duty and non-duty members. Talking about disability specifically with regards to the demographic experience study, what we observed is that fewer members are receiving these disability benefits overall. So at this point, these members who left on disability or terminated partway throughout their career or worked a full career and retired, they start receiving their retirement benefits and continue to do so for the remainder of their lifetimes until they matriculate out of the system. Which brings us to mortality rates. Probably no surprise to many of you, but members are living longer. But the rate of improvement in our mortality assumptions is declining a little bit compared to our last study. One other note about mortality I think you might find interesting is that the Society of Actuaries published a new set of mortality tables that are specifically geared towards public pension plans in the United States. They also broke down those mortality tables by specific occupations, which we decided to use. So there's tables that are geared towards general employees, another set of tables that are for teachers, and lastly, of course, a set of tables that are specific to public safety. So at this point, the graph is complete. We've followed these members from when they first joined the system till everyone has left. And so I wanted to give you a sense for how this graph would look when we layer in all of our new demographic assumptions. Well, I put together the graph and originally had it in the presentation, but when I flipped to the next slide to show it to you, it was almost imperceptible, the difference in these two graphs under the new demographic assumptions. So I'd kind of liken it to two parents standing next to each other, taking pictures on Team Picture Day for their kids' T-ball team. If you were to look at those two pictures, you'd probably go, well, they're taken at slightly different angles. Maybe in one picture, a kid's blinking, and another one, a kid moved his arm a little bit. But the big picture is really the same. And that's what we're seeing with Left Plan 2. At this macro level, the big picture is essentially the same. Where you would see differences in this graph is if you were to look at other retirement systems, other plans within Washington. So in the appendix, if you're interested, I have PERS 2. And the basic shape is similar, but the magnitudes are quite a bit different. So the last thing I wanted to do is give you a sense for how these major categories translate into liabilities within the system. So let's take a look at these percentage points here. So that non-vested group at the far left, you have 20 people who exited the system, but it only represents 2% of the liability. Again, they're only receiving back their own personal member contributions with interest. To a little bit larger degree, that terminated group, they're 7% of the liability, that blue shaded region. They've only worked a partial career, which is why a vast majority of the liabilities, 84%, are attributable to that retiree group. These are the ones that are working a full career. They have the most amount of service and consequently the highest multiplier. They're also, members tend to have their highest average final salary right at the end of their working career. To a little bit lesser degree, we have our pre-retirement death and disability benefits. There's only about 5 people in each of those categories, but they do still represent a material portion, 2% and 5% of the liabilities of the plan.
Jason? Could you go back to that?
I'm sorry. This is Mark. I just had a question. Didn't mean to interrupt.
You did.
I don't. Sorry. So for the 2% and the 5%, there are a relatively small number of folks who have relatively higher liability to the plan. Is that because they haven't paid in longer, or because their benefits are higher, or how does that calculation work?
Yeah, good question. If you were to look at the PERS graph in the back, I actually chose not to include pre-retirement death and disability at all for PERS because it's such a small portion of the benefits. But with Left Plan 2, you have a lot of duty-related death and disability benefits, and so they constitute a noticeable portion that I wanted to highlight for you.
Okay, thank you.
The calculation, you start off with the individual being 30 years old, and it looks like by your chart, the last individual's retired with 40 years of service. And from there, the number of years that they collect their pension would be, did you calculate, I know it goes out to 100, but the average mortality of the chart would be, do you have an average of?
I think we're about 87, 88 right now.
Is that right?
For life expectancies.
You live that long? Is that hurting you? I mean, that kind of hurts a pension plan. Well, I'm okay with it, trust me. Okay, so you have calculated that.
Yeah,
Okay.
So this is taking into account some people live longer, some people live shorter, but
Right.
this is projecting it all the way out until virtually all members have left the system.
Yeah, I'm looking at the 40-year work history, and I'm looking at the 30-year history and the difference in deaths. So, thank you.
Michael,
Yeah.
one of the things that the left members hear quite frequently, especially on the member side, is that their life expectancies differ dramatically from the general public. I still get emails from people saying that the average life expectancy of a firefighter is only 65 years. And so one of the things that I'm telling them is that to the extent that left members retire on a service retirement as opposed to a disability retirement, that their life expectancy is generally within just a year or two of the general public. Is that, does that hold true?
Yeah, while the Society of Actuaries did implement occupation-specific tables, the life expectancy is not dramatically different for public safety compared to the other groups. Teachers is a little bit longer than some of those, the other two, but public safety is in that same vicinity.
Thank you.
Okay, so that wraps up the visual portion of the presentation. A couple other topics wanted to mention. Other major category of demographic assumptions we looked at is the service-based salary growth, and that was covered in quite a bit of detail in the economic assumptions presentation. Don't plan to dive into it too much here, but in terms of what we observed as part of the demographic experience study, in this case, the salary increases we were measuring were quite similar to our prior expectations. And our kind of catch-all bucket for miscellaneous assumptions. Some of these may be familiar to you. We have assumptions related to military service credit and, of course, duty-related death and disability benefits. For these assumptions, we made basic updates to them, taking into consideration new data. But for the most part, we really tried to focus on keeping these assumptions as simple as reasonably possible. Last kind of side note wanted to highlight for the board is that we did review law enforcement officer and firefighter experience separately as part of many of our assumptions that we analyzed. And in certain cases, they did appear to exhibit slightly different behavior. but it wasn't significant enough that we felt we needed to make a separate set of assumptions for those two groups. So all the assumptions remain blended, where we include both law enforcement officer and firefighter experience. Which brings us to contribution rates. So here's the impact to the entry age normal cost rate. As you can see, the contribution rate impacts are pretty limited. And wanted to highlight that the miscellaneous assumptions, we don't have that quite yet. We're still processing that. But overall, I would say that they generally have minor impacts to estimated plan costs. But if we look at the impacts by assumption, my kind of summary for that is that I would say our historical experience suggests that it was quite similar to even our previous set of assumptions. So the modest changes we're making, we just feel are looking at better predictors of the future going forward. If you had any interest in the other retirement systems, I have a few notes in the appendix of this presentation as well. So as for next steps, for the State Actuary's Office, we need to complete our draft report and then collaborate with that external actuarial auditor that I mentioned next spring. Finally, we'll incorporate these demographic assumption changes into our 2019 actuarial evaluation, which then impacts contribution rates that will be collected during the 21-23 biennium. Next steps for the LEF 2 board. Again, no action required today, but this isn't the last you've heard from us. You will receive another update next interim. And as I mentioned, I have a pretty healthy appendix available for you if you have any interest. Otherwise, that concludes my prepared remarks, and I'd be happy to take any questions.
Any questions? I think we're done. Thank you, Michael.
The third actuarial presentation this morning is a follow-up on the topic that you've been studying this interim regarding your actuarial cost method and the associated actuarial assumptions. The presenting team of Lisa and Mitch is back again for this. With that, I'll just turn it over to you.
All right, good morning, Mr. Chair, members of the board. For the record, Mitch DeCamp, Office of the State Actuary. I am joined by Lisa Wan, our Deputy State Actuary, and we are very excited to bring to you the Pension Funding Part 1 follow-up. So for the purpose of today's presentation, the board has an opportunity to adopt a new actuarial cost method if you so choose. And you last heard from us on this topic back in July, so we wanted to review a little bit of that material from July, as well as give you a little bit more information for your consideration today. Specifically for today's presentation, we're going to cover a little bit of background on pension funding, some review of the actuarial cost methods we talked about, some benefits of each cost method, and then how the cost methods compare under the 2017 Actuarial Evaluation Report. And then there is possible board action today if you choose. Starting with the background on pension funding. So what is pension funding? Pension funding defines how to accumulate assets to pay for the plan benefits. So we have members out there working, earning benefits, and pension funding is our plan for how we pay for those benefits. Now there's two key components to pension funding. The first of those is the actuarial cost method. That's part one. That's what we're talking about today. A few key notes on the actuarial cost method. First of all, what does it do? Well, it allocates pension costs to different time periods. And that just means it's your formula. It's your formula that tells you how much do you put away each month to make sure you can fully fund your plan benefits. There's also many different types of actuarial cost methods, and they typically vary in how quickly they fund the plan. However, all cost methods produce rates that fully fund the plan when assumptions are realized. The second component to pension funding is board funding policy. And these are policies that overlay your actuarial cost method to help the board achieve specific funding goals. So a couple funding policies that come to mind are asset smoothing and minimum contribution rates, and these help the board achieve their goal of stable contribution rates. Now, we're primarily going to be talking about board funding policy at the October offsite, but we're going to touch on it just a little bit in today's presentation as well. So looking a little closer at actuarial cost methods, every cost method has past and future costs. For past costs, these are the cost of any experience that is different than expected. A good example of this are salaries or investment returns that don't match our assumptions. When they don't match our assumptions, there is a past cost to that actual experience. Sometimes you hear these referred to as actuarial gains and losses. The other piece to past costs, this is changes to plan provisions or assumptions. Excellent example of this one is a retroactive benefit improvement. You can think of a retroactive benefit improvement. It applies to past service. That benefit was not funded when that past service was earned, so it creates a past cost. The other piece for cost methods is future costs, and this is the cost of next year's benefits all active members are expected to earn. So if we think of active members active 1 year to the next, they typically gain another year of service, typically earn salary increases, and take a one step closer to retirement. All of these have a cost associated with them, and they all are in that future cost bucket. So all actuarial cost methods have both past and future costs, and they differ in how they calculate them and then what they do with them. So that's what we're going to talk about next. I want to talk about how the two most common cost methods used in public pension plans handle past and future costs. And these are the two cost methods we're going to be focusing on for the rest of the presentation. The first one, entry age normal, or the EAN cost method. Key note here is it calculates two separate contribution rates, one for past costs, one for future costs. Those past costs, that's known as the unfunded actuarial accrued liability. That's a mouthful, so you typically see it abbreviated as UAAL. This requires an amortization policy, and all that means is we need to have a plan for how fast or how slow we are going to be recognizing past experience that didn't match our assumptions. For future costs, that's that cost for all active members. That's known as the entry age normal cost. To get the total rate under the entry age normal cost method, we add that past cost contribution rate to that future cost contribution rate. So you calculate them separately, but you add it together at the end. The second cost method is the aggregate cost method, and this rolls both past and future costs into one contribution rate. You can think of it as quite literally aggregating past and future costs, and that's called the aggregate normal cost. Key note here is that there's no separation of past and future costs. With no separation of past and future costs, there's no amortization policy necessary under the aggregate cost method. So now we have a few notes on here on why the board might choose the aggregate or the entry age normal cost method. First of all, why the board might stay with the aggregate cost method. It is the board's current cost method, and it's used for all other Washington state retirement plans, so there's some consistency and easier comparison between plans in this state. The aggregate cost method also just has that one contribution rate that rolls everything together. There's no UAA amount or surplus amount separately identified, and so there's no amortization policy necessary. And the aggregate cost method has provided a very solid foundation for LEF2's historical funding. Now some reasons why the board might switch to the entry age normal cost method. The first one is there's some potential for increased consistency with policies and other pension plans. I'm going to focus on the policy piece first. So one component of this cost method is used in the board's minimum rate funding policy. So the board has minimum contribution rates, and that minimum contribution rate is based off of one of the components in the entry age normal cost method. So you're already using a piece of this cost method as your minimum contribution rate. And we're going to show you what that looks like later in the presentation. The other piece on the consistency with other pension plans, the entry age normal cost method is used by the majority of public pension plans nationally. So it can provide an easier comparison if it's your underlying cost method for comparing Left Plan 2 with other plans in the country. And finally, results under the entry age normal cost method are used in financial reporting as required by GASB, the Governmental Accounting Standards Board. So we are already producing some numbers under this cost method. And I know I gave you guys a lot of information there. I'm going to pause. I am available to answer any questions before I hand it off to Lisa, and she's going to get to the good stuff, the numbers.
Any questions for Mitch? Pat?
I gotta go for it. The GASB board, isn't that a voluntary board that actually just makes recommendations and nobody's required to follow them?
I believe that we're supposed to follow them. I don't know if it's voluntary. I have to say I don't fully understand exactly what they require or don't require, or what you do or don't have to follow.
Do we know who sits on the GASB board?
I do not.
Okay.
So they're not required to use for funding pension plans. They are required to be used
Just for reporting.
For financial reporting. So like the reports, the comprehensive annual financial reports that are produced by the state and DRS, those are required to use GASB. For funding purposes, which is what Lisa and Mitch are talking about today, GASB is not mandatory. It's only for the financial reporting as opposed to the rate-setting piece.
Yeah.
Somewhat, that's always been my concern. There's the FASB and you got the GASB, and they sit in a room, they come up with ideas, and then we're supposed to follow. And it's always been a little bit of a contentious relationship, because to try to get to these people, nobody knows usually doesn't know who they are, and you have to find a financial person to go find them. And it just bothers me that they make these recommendations and we have to follow them, and it costs us money. So that's just an editorial. So thank you.
If I may, just to add to some of Steve's comment, one way of thinking about it, I think Steve described it really well. I mean, accounting versus funding. I mean, accounting is part of our world. You know, we can't get away from it. So if you are a governmental entity and you're following GAAP accounting, you will be following GASB. But you are reporting, you're reporting these liabilities, for example, in the state's CAFR, and GASB is trying to separate accounting from funding. Speaking, sort of describing what I think they are trying to accomplish. They want a independent measurement of the assets and liabilities, so that someone can compare it to the funding policy. And if there's significant differences between the two, someone's got to explain it. Years ago, there wasn't a lot of difference between accounting and funding, and it was very hard for people to sort of independently evaluate the funding policy if all the numbers look the same. But I agree with you in terms of like where GASB comes from and who's on the board. That changes regularly. It's a separate, it's a separate institution. But putting it in context, they're just helping people report their accounting who want to report under GAAP. You're not required to follow that for funding. And part of what I think Lisa and Mitch are explaining to you is because we have this accounting and funding and they're frequently compared, one of your considerations is if those numbers are really different, if you're using one cost method here and another cost method there, yeah, it can lead to some confusion. If that's something you want to manage, that's one of your considerations. You could also say, I don't care and I want them to be separate.
Well, we can't do that anymore. That's the whole thing. It was more of an editorial because I've had problems with them before and trying to do estimates, and this is nothing against you. Have to follow. I mean, you don't have to, but if you don't, you'll be a pariah within the organizations if you don't do what they ask you to do. I've seen that before too, and that was about 4 or 5 years ago. So they set standards, they make recommendations, and if But and even though they say you don't have to, if you don't, you become an outlier. So, and that's just it wasn't about your presentation. Matter of fact, your presentation is very good. I just had a chance to take a shot. You kept on asking for a question, so I gave you one. Thank you.
But I think I'm glad you shared the comment because it is great context for this. Because, for example, you have a minimum rate policy. GASB's not going to tell you to adopt minimum rates. GASB's not going to tell you have to have a stable rate policy. That is a separate funding policy adopted by the board for your separate purposes, which is serve the plan well. GASB's going to have us independently evaluate the health of the plan, in essence, ignoring that funding policy. I'm grossly simplifying this, but that's kind of how I see it. But.
Any other questions? Okay, I think we can move on.
Okay, thank you, Mr. Chair, members of the board. Lisa Wan with the State Actuary's Office, and I get to talk about how this looks in real life. So this reminds me of when I went to school and was getting my degree, and I quickly learned that pure math was not my thing. So what we've talked about up until now is a bit more of the theory and information behind these cost methods, and now we're going to take a chance to do the applied math, which was way more in my wheelhouse, and look at how it really looks for your plan when we look at these two different cost methods. So what we're showing here on this slide is our most recent published valuation for LEF2 was the June 30th, 2017 actuarial valuation report. And this is how the contribution rates would look under these two different cost methods. On the left, your current cost method aggregate would show 6.44% contribution rate in your valuation report. On the right, if you move to the entry age normal cost method as your underlying cost method, in the actuarial valuation report, we would show the components that Mitch talked about. First, your future costs as your normal cost, 8.59%. That might look familiar. The next component, the past costs, the UAAL, and this is a piece that gets amortized. As Mitch mentioned, you'll have to have an amortization policy if you move to this cost method. At that point in time, that would be negative 2.57%. And as Mitch mentioned, if you adopt the entry age normal cost method as your underlying method, we would show these components separately, and the rate for that method would be the sum of those two components, 6.02%. So that shows you under the two different cost methods what contribution rate would be required to attain full funding, which every cost method is designed to do, is to attain full funding in your plan. Now, that negative 2.57, where does that come from? The fact that at that valuation date, LEF2 has assets in excess of earned benefits. In other words, your funded status is over 100%. Some people may say you have a little bit of surplus or reserve in the plan. That means that your past experience has been better than expected. And so you have a negative UAAL. And this cost method is saying you don't have to contribute at that 8.59 just to get to full funding. We can actually bring that rate down a bit by that unfunded liability component to attain full funding, to get to that goal of full funding. And in this example, we had to make an assumption about what your amortization policy is so that we could show you numbers, so we could show you the applied math piece. So we assumed a 15% amortization, 15-year amortization for that past cost piece component, which got us the negative 2.57. Now, the entry age normal cost would require that amortization policy, as we've talked about, whereas aggregate does not, because it rolls everything just into one contribution rate. It's basically amortizing past costs over future expected payroll for the plan. But it rolls it into one. So this slide gives you an example of how that number, that UAL amortization piece, would change under a different amortization policy. So it's just giving you an example. If you do move to the entry-age normal cost method, you have to set an amortization policy for that cost method. This gives you an idea of how that would work. Under a 10-year amortization, then that number would change from 2.57 to 3.21, and your total contribution rate under the plan would be 5.38. Basically, the amortization policy is just determining how quickly or slowly you're paying for those past costs or savings. So that was the example of what your contribution rates would look like for your plan based on your most recent valuation results that we have published, so that you could kind of get your hands around what this would look like, what it would look like in your valuation report, how it would be displayed. The next two slides are starting to really talk about the things we're going to address at your next board meeting, which is the second part, which is pension policy. So the first part, the cost method; the second part, the policies that overlay your cost method. So first, starting with, and as we mentioned in July, when you have a cost method and your funding policies and you bring those two together, really you can achieve whatever goal the board is trying to achieve. So for example, one of your main goals has been rate stability. So under your current cost method, you've got your aggregate, and then you've added this minimum rate policy in order to achieve stable rates. And as Mitch mentioned, that minimum rate policy has come from the entry-age normal cost method. So you can see it is that 8.59% normal cost from the entry-age normal cost method. And you can achieve rate stability and have minimum rates also with the entry-age normal cost method. So for example, if you move to the entry-age normal as your cost method, you may end up adopting a policy that says we don't contribute less than the normal cost under this cost method. If that was the direction you went, this table shows what that would look like for each cost method. So on the left-hand side, you have your current cost method and funding policy, which is aggregate and the normal cost from entry age as your minimum rate. So 6.44% aggregate, 8.59% coming from the entry age normal cost method. And that's what you've been adopting for the past several years, is that minimum rate for the plan. If you move to entry age normal cost, again, we're showing those same rates from the prior slide, which would have 6.02 as your total entry age normal rate. But then if you, for example, said our policy is we don't contribute less than the normal cost, well, then that becomes your minimum rate, 8.59, and you're in the same position. So this helps you see that your cost method and your funding policies can work together to achieve the same goals. And then finally, we wanted to also help you see how things would change if the plan was less than fully funded. Now, we had to come up with an example here. We had to, do something to achieve a funded status less than 100% for the plan at that valuation date. So we just reduced the assets by $1.25 billion just to help you see what the numbers would be, just to get to that applied math process of really getting your hands around what that means in numbers. And a loss of $1.25 billion, just as an aside, would be a very significant event, even larger than the Great Recession, for impacting your asset value at a point in time of $1.25 billion. So just for context, that's a significant event. But if that was the case, if that had happened and your funded status dropped to 96%, what would your contribution rates be under these two cost methods? The aggregate would jump almost 300 basis points, the contribution rate to 9.42%. Again, it's rolling everything into one, and it's saying, what's the one contribution rate that's going to get this plan back on track? 9.42%. Under entry age normal cost, that normal cost rate didn't change. Because the normal cost under entry age, and we've talked about that, it's a very stable rate. Some people refer to it as the long-term cost of the plan. It hasn't changed because it doesn't change with changes in assets or some of that past experience. That gets rolled into that UAL component. Now that number is positive, 1.09%, because if you've had that significant asset loss, if your funded status is below 100%, that means your past experience has not been as favorable as our assumptions. It has been worse than the assumptions. We have an unfunded position. We need to get the plan on track. How are we going to do that? We're going to add this unfunded liability rate of 1.09 to get the plan back on track. And now you're at a total entry age rate of 9.68%. So that's how these two cost methods would play out in a situation where the funded status dropped below 100%. Now, this is some of the stuff we're going to be talking about at the next board meeting, the policies around your cost method that will help deal with some of the concerns the board has shared with maybe the funded status getting to a certain point above 100% or getting to a certain point below 100%. And this example is showing you that at any time that the funded status drops below 100%, your underlying cost method will kick in and will increase your rates in order to get the plan back on track for full funding. So I think we'll spend more of the time at the next board meeting talking about what happens if the funded status gets to a certain level above 100%. That's where you may need some policies in place to take care of that. So next steps and the summary of what we've shared, this will mostly be the last time we'll be talking about the cost methods. There'll be a little bit of that when we talk about your funding policies at the next board meeting, but we just wanted to summarize with reminding you that each cost method, along with appropriate funding policies, will provide a reasonable approach to plan funding, so either of them. Either cost method, along with your funding policies, can achieve your goals. The board has an opportunity today or at a future board meeting to affirm your current cost method or adopt a new cost method. And as I mentioned, the next board meeting in October is when we'll focus more of our discussion on funding policies. And just as a reminder, we are available to answer questions, provide additional analysis, anything that will assist the board in this process. So that concludes our remarks, and we're happy to take any questions you might have.
Questions for Lisa?
Just out of curiosity, what type of funding method do we use for other retirement plan, like PERS 2 or PERS 1?
So all of the other Washington State retirement plans, aside from the closed plans, they have sort of a hybrid cost method. All of the open plans use the aggregate funding method as their underlying cost method, and they all also have minimum rate policies using that normal cost from entry age, but they have them in different amounts. Most of the plans, it's 80% of the normal cost. Left 2 board has used 90%, now uses 100% of it, and State Patrol is at 70%. So they all have the aggregate cost method and then a minimum rate policy from the entry age normal cost.
Thank you.
Any other questions? All right, thanks, guys. Great presentation.
Thank you.
Appreciate it.
All right. Following up, we have another presentation from outside the agency. Mark Feldhausen is here from the Department of Retirement Systems. When the board was first created, the board affirmatively chose to leave the responsibility for administering pension benefits with the Department of Retirement Systems. And then part of that agreement was that the department would report to the board every year in terms of how efficiently they were administering those benefits, and also in practice what they were doing to administer benefits. Mark is here to talk about that, the first piece, the efficiency of the board or the department's administration of benefits. And with that, I will turn it over to you, Mark, for your presentation.
Okay, thank you, Steve. Hello, Mark, you still on the phone?
Yes.
Great. Sorry you're not here to see this, but it'll look fairly familiar to past presentations. The data is still good, and it's still me doing the presentations.
Excellent.
First, a quick introduction of the firm that we've been using for public pension administration benchmarking for now over 20 years. And I've been doing it all those 20 years, leading the effort here at our agency, Retirement Systems. And I don't know, Steve, if you were in the meeting we had over 20 years ago when Mike Heel came out from Toronto to talk with us about the service they were developing. It was kind of in its infancy at the time. They actually started out, they being CEM, started out looking at investment management benchmarking for public funds. And in that process, after going through that for a few years, they also started looking at this other aspect, the administrative aspect. You know, why did that differ? Because they were started out looking at the difference in investment returns and the types of investments out there, how much people were putting into that. And they figured, well, maybe there's another business avenue here. Let's look at administration and how it differs between the participants. And they really did start out in Canada, the neighboring areas, and with some of the states around there. We did not participate in the first year. We got in on the second year, but they do currently serve over 400 companies and entities around basically around the globe. And this is just one aspect of their service I'll be reporting on. Excuse me. In the fiscal year 18 survey, we were one of the participants, one of the 64. You'll notice there that it is still dominated by systems, public systems in the North America. But they do also have systems that participate from Europe, including primarily a good solid contingent from the Netherlands and others from the United Kingdom. They also have other participants that they're working on in pension administration benchmarking. They don't get included in our reports, though, and in our comparisons, because the systems they administer are so different, they really can't compare to what's going on in North America. And that is the case for the UK and the Netherlands. It's also the case for the systems that they work with out of Australia, further Eastern Europe, Asia, as well as Africa, Central America, and South America. So they are getting even more international as the time goes by. Matt and his team mentioned a peer group for actuarial purposes. There is a peer group for benchmarking as well. The definition here, though, is very simple. We are compared as peers to the other larger U.S. administrators, and the larger cutoff point is 300,000 active members and annuitants. Within our fiscal year 18 data, we're at about 500,000 in those two added together, and we sit at about the median for the peer group of the larger participants. This map shows you where the states that they're located in and then gives you their acronyms as well. I bring this up to show you that it really is a good diverse group of larger U.S. systems around the United States. And in addition to that, the orange state shows where the smaller participants that aren't in our peer group are located, and the lightest shaded states show where there isn't a participant in 2018's database.
The only states that would have someone that would actually come into our peer group would be New Jersey has a system, Maryland. There's a few systems in the state of New York that didn't participate in 2018. And then there's some states in the southeast that have never participated. Georgia, Tennessee, Alabama all have systems that didn't participate. And it is one of those things that I've been talking with CEM with over the years, kind of our own selfish interest in getting the peer group even larger is to get more best practice ideas. The possibility does exist that there is someone out there who's doing something very unique that we could take advantage of. And in participating in this service, there is this willingness to help others to become better, to share best practices, even better practices and approaches. So the more that we can get to participate in this, the better it is for us. Now, before I talk about the data that is on this chart, you'll see a few other charts that look like this. The way of looking at this is all the North American participants, the U.S. and Canadians, are reflected as a separate column. The column that represents DRS will be the darkest column. The medium shaded blue columns are the others, the larger U.S. systems that are in our peer group. And then, of course, the lighter shaded ones would be the Canadian systems as well as the smaller U.S. participants. This particular chart here shows total cost. CEM goes to great length in their survey to get you to start with the CAFR has been mentioned, the Consolidated Annual Financial Report. You start with that, and then they try to boil it down to get it to apples. So they have a very extensive definition on what are the 30 common public pension administration activities. They want you to isolate your costs into those 30 and only include those. They want you to make sure that if in your CAFR you have investment management costs, keep those out of this equation. Those are actually benchmarked in the investment management benchmarking. If you have voluntary pension systems that you're running, like in our case, the deferred comp program, which is not a mandatory, but it's a voluntary participation, they want that out of the equation because that's not a common administrative activity nationally. They also want you to take out if you're also responsible for any aspect of healthcare administration. They want you to keep that off to the side. They really do want this to be apples to apples. That being the case here, you see that DRS, our cost, which includes a good portion of the actuary's cost because that is a common pension administration expense. Very low cost. We're actually in the lowest 25% or the lowest quartile as far as our cost per member. And you see with that inset, the line graph that's in there, over the last 4 years for common participants, we've consistently been very low cost in administration. The next chart here looks at total service, and this is a composite score that may look at close to about, I think the values from close to 100 of the 1,000 questions in their survey, where they're looking at those data points, and it looks at your responsiveness in services to members. It will look at the different channels that you might have as far as getting and offering service to members. It will look at the time of day you're available to provide service to members. So it takes all those different data points, rolls it all up. It will weight the different components that they're bringing in. And in this one, we've been fairly close to the median throughout the 20 years where our service score has tended to be typically a little bit above median. Not extremely high service, but never below median. Now, this was one of the items that CEM over the years has been trying to come up with a predictive element that they could look at so that they would be able to say, oh, now we know why DRS in the state of Washington costs $60 per member and state X costs more or less per member. It is because of, and they are always trying to point to one cost driver. And over the years, they've looked into things like service. They've looked into things like complexity. They looked at your cost environment. They were approached by some of the systems out of New York that were saying, well, you know, I'm one of the New York City systems. My headquarters in Manhattan, my rent is just horrendously high cost compared to the system in Kansas, the system in South Dakota. That's why I'm high cost. CEM would go down that, get those data points from all the participants. Nope, that wasn't it. They would look at complexity. You had some systems tremendously highly complex, even more than DRS, very high cost as well, and CEM would go down that rabbit trail, if you will. Nope, that is not the predictor. Service was one of them. You had the participants very high on the service scale, very high cost. They wanted that to be, that's got to be the predictor. We're providing tremendously high service. That comes with a cost. That must be it. No, that doesn't line up. Which gets at this next chart here. If that were the case, that there was a direct relationship between cost and service, what you'd expect to see on this chart is all those data points from all the participants would line up from the lower left of low cost, low service and run straight up to high cost, high service. And all of them would fall along that line and be very close to that line with maybe a couple outliers. They don't do that. The predictive value of total service doesn't line up with total cost. Now, being faced with that and trying to be cost effective themselves, and also being sensitive to the feedback that they would get from various participants of all the work that would go into filling out a 1,000-question survey, they figured, we can make this easy on you guys. We can start reducing down the component of service in the survey. And they threw that out on the table at one of their conferences, and it was almost a unanimous, instantaneous reaction from all the participants in the audience, no, don't do that. And it has to do with the value of all of the data that they put into the survey and that they put into the eventual report that we're very interested in. You know, who is doing something out there that we're not doing? Who is doing something better? Who might be doing something quicker? And with the data, all the other data that's in there, who's possibly doing something at a lower cost, even better than us, for a specific component? Who is kind of on that leading edge of looking at different web apps and what type of uptake are they getting, you know, and member interest. So there's so much interest in that's how we would get input on potentially improving our business, other than from individuals like yourselves in our authorizing environment that have us look into things, feedback from members that we feed into this as well. We wanted to be able to see that. And one of the sections in the report gets at answering the question of what will we have to do to get that perfect 100? You know, how do we get our A+ in that quadrant of the survey? And I took the top 4 here out of that had the top 4 point values, and I superimposed on the service score chart. Well, we could move our column as identified here by this green overlay. We could jump a couple peers and move further down to the right if we did these 4 things. If we answered our telephone quicker, but in that, you have to understand that when they start and stop that stopwatch there for that metric, it is from the time either your system or one of your employees answers the phone to when the call gets to what they define as the knowledge worker. It has to be, when does it get to the person that actually is capable of providing service to the incoming caller? If you have any sort of a initial phone tree that is intended to direct your callers to the right areas of your agency, that's part of the time clock. And we've done a tremendous job over the years in basically making that more efficient, looking at where do people, you know, push the button, where do they eventually want to get to, how does that change over time. We've gotten that to be, you know, fairly efficient. But one of the things we have that certain peers don't have is, because we're an umbrella administrator, you have various levels of complexity and expertise where you might have specialists that you're trying to get these incoming callers to. you can't have one individual that can answer any incoming call, where in comparison to someone that to get this maximum score for that one component of the total service score, we probably would have to be able to answer the phone as quickly as the non-peer of Ontario teachers, where you have a systems administrator that has a homogeneous employer group, a homogeneous member group. They're all in one province. Basically, any incoming call, one of their retirement specialists, they can feel that they can answer it. So if you have your call center staffed with your retirement specialist, they can pick up that call, they can answer it instantaneously. You don't need to have any weeding out and redirecting of the incoming calls. So our structure places us a little bit slower in phone response. The next one would be having us review more incoming calls for coaching purposes, whether it's having a senior analyst on the line listening to an incoming discussion, or one that would review audio recordings of the incoming calls for coaching purposes, to be able to basically talk with a newer retirement specialist and kind of coach them on what they could have done better. If we did more of those, we'd get a higher score there. The third one is one that I anticipate in the future will actually be dropped out of the service score because of automation. And this really, if you put it in the context, it has its origin in over a decade ago when they did a best practice analysis of what was that perfect annual statement that could go to a member. And the one that they placed in front of us was about an 8-page glossy, mailed out to the member's home address, including to inactive members. And it gave all of the detailed background of the entire retirement system, and then it was individualized for that member to provide, the last year of all of their service credit data, their comp data, and then this last little part that was also in there was, okay, if you retire, when you become eligible for a full unreduced normal retirement benefit, potentially 15, 20, 30 years from now, here's what we project your retirement benefit will be as of that date. And then with a footnote, asterisk, with all of the underlying assumptions that would go in behind that. The argument that numerous administrators have talked with CEM about on this is, why would we build that, especially in this day and age, when a member can log in, especially into our secure website, to a calculator that is linked to their data, and they can do an infinite number of scenarios? Or what if I retire in April of 2021? What if I wait a few months? What if I hang around for a couple more years? What if I get this job over here and my salary actually gets bumped up a little bit higher? They can put all those variables in and run out the different scenarios. The final one there is one where our service score isn't as high as it could be because we don't have field offices. Now, one of the aspects of this one is that in the future we might actually be able to get credit in this one, because what this requires is you have to be able to do a one-on-one counseling session with a member at the same level of complexity and service that you can at your headquarters, if you will. And as technology continues to increase, we have retirement seminars at locations in the field. We will have members come up and talk with some of our retirement specialists that are conducting the seminars and do almost exactly the same type of an interaction as they could if they were back in one of our conference rooms at our headquarters. But we have to be able to say that, yes, 100% of the time they're getting the exact same services they can get at our building in Tumwater. And until we can get to that point, we can't get credit for this one. I mentioned complexity as one of the other cost drivers they've looked at over the years. And this is one that regrettably have always been very high, off to the right, and that gets at how they measure complexity. And really, the simplest way of talking about this is it's a measure of all the different rule sets that you have to basically master and be able to answer and build into your systems to be able to work with all of your different member groups. And because we're an umbrella administrator and we administer all the different public pension plans with very few exceptions in the state of Washington, we have what tends to be a very complex set of rules and differing rules to administer. The peers, if you will, that sit further to the right of us, you have, of course, the most complex column there, and this is one of the things why you don't see the other peers named. CalPERS has given us permission to identify that they're the most complex administrator. We do not envy them in their position, nor would we want to ever pass them in their level of complexity. It does, at the extremes, CEM has identified that at the extremes, complexity will impact cost. And in their case, it really does, and you can see kind of how it touches different aspects of their business to drive up their cost. And it's also one that's very hard to move yourself back to the left. You really can't change complexity because what that requires would actually be to change your rule sets. I remember a discussion with Virginia Retirement System where they were actually able to reduce their complexity, but the way they did it was by really more consolidating their PERS rule sets to come up with kind of a homogeneous PERS for all their different, typically local governments and employers. In that case, the difference between their rule sets wasn't that significant, so it didn't then also have an impact actuarially. Because what they did was they consolidated them all to the most generous rule set. Well, because there wasn't a lot of difference, it was fairly easy for them to do that, including cost-wise. For us to basically have all of ours basically consolidated into one rule set for all of our member groups would be tremendously high cost. The actuarial cost would exceed the administrative savings. This page right here shows the comparison related to information technology, where you have the top chart there looks at how much we spend on information technology. On this one, of course, you want to be lower cost, and we have consistently been below the median in how much we spend on IT. The chart below it looks at the capability of our systems, and this is one where we've always had very good scores on the capability of our systems, and this really looks at it from multiple angles. It looks at the capability of your systems to have your employers report the data and the contributions into you. It also looks at the capability of your systems to help your team members provide service to members, to do all the calculations that they have to do to actually retire a member. And the third thing it looks at is the capability of your web-based self-service. And then because CRM is in there, it will also look at the capability of your phone systems. And in this one here, our column would actually be a little bit further to the right if we had more voice response systems. And Steve may remember this discussion, putting back the Wayback Machine, sitting around and looking at kind of making that decision years and years ago. Do we invest more in this new internet webby stuff, or do we invest more in a voice response system, a telephone system that members could use to get service? And at that time, there was a lot of feedback and some analysis being done on how much taxpayers, citizens of the state of Washington disliked calling into a public entity and getting a voicemail or a phone response phone tree and having to navigate it and ending up getting to voicemail. So within that context, there was really no way we were going to go and invest a lot of money in a phone-based member service system. It just wasn't the direction to go in, and it really did put us out there as far as getting into being one of the more early systems that started developing the web self-service, web-based information website. I think it positioned us a lot better for the future, especially when very few of our peers are really even putting any more money into their voice-based systems now. Excuse me. This slide here gets at answering a question that was posed to me about a year ago when our budget proposals for continuing to modify our systems were some very well-developed integrated mainframe systems that were developed back in the 90s, built back in the 90s. It's coming around time to have those systems, those legacy systems, be modernized, be replaced, be replatformed, redesigned. That is going to have a cost to it. And the question that I got was, well, aren't you worried? You're going to go from being low cost, your reports are not going to be as good anymore, not going to be as fun anymore, because your column is going to race down to be high cost. So I looked into that and kind of looked at the data and came up with, well, what would it take to move DRS's column to the right? How big would those projects have to be? And considering the ones that we had as far as budget requests, the answer to the question is no. When I come back next year, if I'm asked to come back next year, and if I'm still doing these reports, the column will only really move a couple to the right. It really doesn't have that big of an impact. And what this gets at is just how low cost we are to start with, but also how much, how big those projects have to be. If you were to think of moving our column down closer to the median, the size of our projects would have to be about another 10 million or so in a fiscal year. If you look at moving us down to be closer to the 75% line, which is about where you see that question mark, you would have to essentially double the size of DRS's budget, and that would all have to be in a major project. And if you wanted to have us join the two piers way down to the right, the two dark columns, you would almost have to quadruple the size of DRS's budget in a fiscal year, all for major projects. I've mentioned I've been doing this for 20 years. I've actually been at DRS a little bit longer than that, and I think back at the size of our decision packages, our fiscal notes that we've sent in. I couldn't come up with even one of them or a handful of them, put them all together and take all of their 6-year costs, collapse it down into one fiscal year to be able to drive our column down to the maximum or even down to the third quartile there under the question mark. That's how big of a project we would have to have to be able to move our column down to have DRS not be able to say we're low cost or at least we're below median. It would be a massive project that we haven't seen. With that, just quick summary. We get the comprehensive and independent analysis from a third party on this. It is a very strong data-driven comparison to our peers. It provides us with an operational network of peers. And there is a benefit, even though we don't get direct comparisons to the international community, there are some very interesting ideas and approaches to pension administration worldwide. And we also get the ideas for continuous improvement. With that, that's the end of my presentation. I'm available for any questions.
Any questions for Mark? Think we good? Go ahead, Steve.
Yep, Mark, thank you for
Thank you,
the
Mark.
in-depth, and thank you for bringing back some fun memories of my time at DRS as well, back when this was all in its infancy.
And you could even ask Karen.
Yeah, I told Karen this. Karen was the first one to do benchmarking for the state, for the Department of Retirement Systems before CEM existed. And I was amazed when CEM's first results came in, and they almost mirrored exactly what Karen had predicted they should years earlier by herself. So yeah, it's been 20 years now. A lot has changed.
Well, and Karen's analysis, you may remember, was prompted by the kind of the national groups that would just take your CAFR, take your total cost, divide by your members, and produce, here's your cost per member. And it produces really very unusual and non-comparable numbers.
One quick point too, your, the inactive members who we don't expect to earn a pension, those are not counted in your numbers for this.
Correct.
Yeah, okay. Thank you.
Thanks, Steve.
Mr. Chair, lunch is ready if you would like to break for lunch. And then I could do the admin update while you guys eat. Give you guys, say, 15 minutes to get your food and get back. Is that enough time? And
Yes, that'd be great. Steve, thank you.
all right. Thank you, Mark. Tim, could you close that door back there?
Okay, we're going to go ahead and call the meeting back to order, and we're going to start with our presentation from Director Steve Nelson.
For the administrative update, I'm doing it a little bit different. Typically, I will give you a quarterly budget update. This meeting, though, the budget update is more about the future budget as opposed to talking about past expenses, and in particular, some supplemental budget update, and I'm going to have that done by Karen. Since she's been doing all the work and is new to the team, we thought this would be a great way to welcome her. She gets to do a lunchtime presentation.
Oh, I see chuckles. Awesome. That is right. We can talk about Disneyland all day long. Good afternoon, Vice Chair and members of the board. Karen Durant, board staff. I'm here today to talk to you about your 2020 supplemental budget update. And I think the actuary's office said they were excited. Not only am I excited, I'm delighted to bring this to you today. So feel free to interrupt at any point to ask clarifying questions. I'm happy to try and answer as we go along. So the board submitted 3 supplemental budget decision packages. The due date for those packages was the 20th of the month. The first of the packages is consistent with what we discussed at our last board meeting, which is the expenditure authority to match the board-adopted budget. The other 2 are on agency relocation options effective April 1st of 2021. The first package on our July 24th, 2019 meeting We discussed some increased expenditures for professional development, salary and benefits, and contracts. The decision package is exactly aligned with what the board adopted at that meeting. The agency relocation, this is more complex, and we can go into that in a little bit more detail. The first option is increased operational office space with off-site rented board meeting space. So there's two components to the decision package. There are one-time costs, which is $190,000 in fiscal year 2021, as I said. Both of the decision packages assume a relocation effective July 1st of 2021. So the one-time costs are based off of assets being purchased, tenant improvements being done to the new property, and infrastructure improvements. We also have ongoing annual costs of roughly $168,000. That's associated with the lease of increased square footage and utilities, the rental of boardroom space. Currently, the SIB provides the board this space for free every month. So we are not under the assumption that that would be an ongoing option for us. Then the third component of ongoing operational costs is information technology would be supported by WATEC. Currently, the SIB provides our operational IT expenses free of charge for the left two boards. So we would be assuming going to the WATEC desktop and service allocation models. The second option for a decision package had increased operational office space with on-premises boardroom, which means basically we would have dedicated boardroom space at any meeting, so it would be predictable space, and because of that, the one-time cost would be $327,000. We would need more assets to be purchased for furniture, tenant improvements, and infrastructure. The ongoing annual costs of $181,000 are increased obviously because it's greater square footage. The same costs for the information technology support by WATEC would be included in that as well. That's it for the supplemental. This feeds into the two packages related to the relocation. We are continuing to work with OFM Facilities Oversight. They have to approve our pre-design, which would give us a little more information as far as detail on the amount of square footage they're going to approve, what kind of option they would allow if they're going to suggest an agency co-location similar to what we have now. Those things are unknown at this point. The agency, we are not allowed to work with the Department of Enterprise Services to identify appropriate facilities until after we receive that approval from OFM Facilities Oversight. So hence, that's why we did two decision packages, because we didn't really know the direction that we were going to be going, so we wanted to hedge bets. As we know more information, as we get approval from Facilities Oversight, we will keep the board informed on timing. Obviously, because these were best guesses based on a couple of options that I put together, there's a real potential for us having a 2021 supplemental budget request as well that will be a little more refined than the several that we're submitting for now. Just by way of background for the board, the legislature doesn't have to approve our expenditure authority. OFM has to approve our expenditure authority. The fund that we operate under is non-appropriated, but it is budgeted and allotted. So legislative staff have been provided with the decision packages so that we've been keeping them on the loop all along on where we're going with this. They've been very supportive, And just so you know, we probably will be coming back with refinements for a 2021 supplemental as well. That concludes my presentation. I'm happy to answer any questions. And I want to clarify, like Steve and Mark were talking about time machines and Durant doing something or other. I think I was 10 when all that happened, so I don't remember much of it, for the record. Yeah. Happy to answer any questions.
Question for Karen? Yeah, Senator Warnick.
There, okay. So are you free to say where you're looking at relocating to, or are you researching that at this time?
I would love to be able to tell you where we're looking. Our preference as an agency is to stay in this vicinity. We are not allowed to even start discussions with the Department of Enterprise Services, Real Estate Services, until OFM has approved kind of the square footage and the parameters. So our desire as an agency is to stay in this vicinity. If we're not able to do that, I think our second preference would be kind of Tumwater area, with obviously consideration for the board's travel to make it close proximity to I-5 and those kinds of things.
It just seems like we've put up a few office buildings as a state, and I just wondered if there was any extra room in some of those. So
We've looked at, I shouldn't say we've looked at, some of the newer ones were suggested to us, specifically the Helen Summers building, and there's no space in there. And then the other one was the new, what was it?
Jefferson building.
And there's no room there as well. The key takeaways right now, the timing got pushed back. Originally, we thought we would have to be out of here before next July, and now it looks like it's going to be maybe 9 months later than that. But OFM, I expected to have OFM approval before now. When we met with them early on, they told us they would expedite their approval, and that has not been the case. And I have had discussions with the SIB director there, because the SIB, the reason we're leaving is they're expanding into our space, or they're expanding and they need our space. They are going through the same approval process with OFM, and they haven't been approved yet as well. Some of the key takeaways that we're going to be losing, in all likelihood, some of the operational efficiencies. As Karen said, they've been very generous with IT support since the beginning of the board, and also very generous in sharing the boardroom. I've talked with their director about the possibility of continuing to use their boardroom even when we're no longer in this building, and that doesn't seem to be something that's going to work, especially long term. The parking requirements to have an outside agency bring in their staff and board members and the public don't match the current capacity of this parking. But so that'll be kind of the two things we're looking at, is what the as Karen highlighted in her packages, the biggest variable right now is what are we going to be doing about board meetings? Moving to an ad hoc where we're bouncing from one site to another month by month is not sustainable. So we'll be trying to find a location that you guys can, and the public can get familiar with. In all likelihood, it will not be as nice as this current boardroom. We're trying to make sure that it's not a dramatic disimprovement, or a disimprovement to the point where it impacts your ability to take care of your business. But the number, this is a very nice facility, and having it for free for the last 15 plus years has really you really appreciate things like that when you're about to lose them, like we are. But for the remainder of this interim, everything will be in this facility. And at this point in time, we expect that for next interim, everything will remain the same in this facility. All right. Thank you, Karen. Also on the admin update, I wanted to talk about, well, first off, since you guys brought it up, I'm modeling new Left Plan 2 Retirement Board brandware. The idea is we do a lot of outreach activities where team members are out at conferences or out at locals, talking about what the board is doing and answering questions. Sometimes we have a table set up, and so we were looking for something that would make it easier for members at those types of events to identify who we were and where we were from. So we didn't just look like somebody who might, a law enforcement officer or firefighter who's there to get their questions answered. They would immediately know we were there from the Left 2 board. As a follow-up, those of you who have been getting off-site education know that it is very common for trustees from plans around the country to have a shirt with a logo that identifies the plan that they're from, and then that facilitates some of that one-on-one trustee discussion that takes place at those conferences. You guys, the reputation of Left Plan 2 as one of the most successful plans in the country, there would definitely be people seeking you out if they knew right away, oh, there's a trustee from Left Plan 2 at this conference, and there's a guy with a Left Plan 2 shirt on, and let me go talk to them. I've got some questions about what they're doing in Washington. So this is something that we would follow up with you guys about potentially in the at the October meeting, seeing if there is interest in like a sweater or a polo shirt is kind of the options that are available. But if that's something that you might be interested in, we could move forward on that. Now, also on the admin update, the Select Committee on Pension Policy met September 17th, and Jacob will be talking about they moved out one of their proposals, and he'll be talking about that. We sent a letter, the chair sent a letter to them identifying the issues that you were working on this interim to try to coordinate those that could cross over. At this point in time, with the exception of the month of death issue that Jacob will be talking about a little bit in a little bit, they are not, none of the other issues that the board is working on are currently scheduled on the SCPP interim work plan. So that coordination could be, yes, Representative Berquist.
Looking at our list here, the interrupted military service credit sounded like there's like a need
Yes.
this session to do something. Is it a problem that they're not discussing?
Well, one of the things, and we'll talk about this as options with you, one of the things that we've done in the past is roll out a Left 2 board bill, and then at the time that you voted out, I ask you if during session it was amended to include the other plans, would you consider that a friendly amendment? So that in the event then that the legislature looks at it and says, no, we don't want interrupted military service for one plan different from all the other plans, we want to keep it the same, and what the Left 2 board is doing makes sense, and they want to add on the other plans, then I'd be able to testify that you guys would consider that a friendly amendment. Done that successfully in the past, and that may be where we end up on this. There's we haven't got feedback in terms of why some of these issues aren't on their agenda. And so for future coordination, that's one of the things we're looking to maybe kind of close that loophole, like maybe getting a letter back from their chair saying, hey, we're working on these and these, but we're not going to work on this and this, and here's why. Pat?
Don't want to extend out the meeting, but if I'm, I think number 9, the survivor option election, is that the one that I was talking about? Is the
Yes.
60-day?
Yeah.
And SEPP didn't want to do anything with it?
No, it's not on their work plan. So that's one where also, because that has an administrative impact, we'll probably not only have to follow up with the select committee, but maybe have to follow up with the Department of Retirement Systems. And they do have the director of DRS is on the SEPP, but try to get a little bit more feedback in terms of, is this something that they're opposed to, or is it just something that they had other priorities first and that they're still...
I would, if we could get an answer. I'm not trying to, DRS does a great job.
Yeah.
But if I'm not mistaken, when we first brought this forward, the cost was de minimis. It was actually office work that they didn't want to be burdened with.
Well, that wasn't their testimony. That may have been the way you heard their testimony. But yes, there will be an administrative impact, and I don't know whether they're opposed to it or not. That'll be something that we'd follow up on.
Thank you.
With each year, the Left 2 board is different from a lot of state agencies. Most state agencies get audited periodically, their financial audits periodically by the state auditor's office. In the legislation that created the Left 2 board was a requirement that you have annual financial audits. And this year we have contracted again with the state auditor's office. They did it last year. They did a fine job, so we're having them do it again this year. And that process, the entrance part of that has already begun, and they expect to have their work completed and be able to report to you by your November meeting. Chantel Wan, who was the administrative intern, her first day back at college is today. But I wanted to give a special thanks. She did a great job while she was here. Those of you who were here for the presentation that she and Jacob did on tribal law enforcement, it was amazing that such a complex topic could be presented as clearly. And for her, right out of the chute, that was an extraordinary job. Next summer, she currently does not have pensions in her long-term career plan, but I'm going to be making a pitch to see if maybe she'd be interested in interning again. I've already made a pitch. She just wouldn't tell me no. But I'll be working on that again next summer. So hopefully there's at least a possibility we could see her again. And then we'll talk about the specific agenda later on. But as a reminder, the October meeting is sort of your strategic off-site meeting. It will not be here. The location will be at the Indian Summer Golf Club out in, I can't remember if it's in Olympia or if it's in Lacey, but in any event, they've got some meeting facilities there. That's where we will be. And I'll talk to you a little bit later on when we about agenda items for future meetings. We've got a couple of questions that we want to ask you guys about that specific October meeting. But in the meantime, we can begin with the afternoon presentations regarding some of the items that we were just talking about. First up, month of death. This is an issue that you've heard several times, and here to give a comprehensive report on that with possible options is the, do we have make sure anyway that we've got the right slideshow, but in any event, I'll turn it over to Jacob.
Sorry, I just noticed the error on the front page. I was checking to make sure we have the right
The
presentation.
rest of it's good. I just noticed the same thing, although I didn't call it out.
Yeah,
So that the
I
board
hope
members.
so. We'll find
All
out as I
right.
go. For the record, Jacob White, staff to the board. Steve said, month of death, which we've done a few times over the last couple of years. So the issue here is that DRS prorates the last month benefit payment based on the number of days the person was alive in the month, and that frequently this results in an overpayment and an invoice being sent to the family or estate to collect right after a family member has passed away. And so this is often caused by a delay in notification of death, or just people dying later in the month after the check has already been processed. So in 2008, the Department of Retirement Systems requested the Left 2 Board and Select Committee on Pension Policy endorse legislative action to pay the full month of death payment. And then in
right here.
last legislative session, there was a bill on this to pay the full month of death benefit, and that bill was endorsed by Left 2 Board and Select Committee, and neither bill made it out of the House of Origin. From what we heard, that was due to the people supported the policy of it, but due to the cost and then just legislative priorities, the bill did not advance last session. And then, as Steve said, at the last Select Committee meeting, the SCPP re-endorsed the 2019 legislation for the upcoming legislative session, and they voted to jointly endorse with the Left 2 Board if the Left 2 Board endorsed the legislation.
I have a question.
Yeah.
Do we have a fiscal impact statement on what that cost would have been?
Yes, and I have that slide coming up.
Oh, okay. Sorry.
Oh, no problem. So some of the policy considerations, the current policy results in a burden for grieving families. As I said, they get, as they're dealing with the death of a family member, they then get an invoice for an overpayment, and it can, that overpayment can also cause issues with their insurance premiums through PEB. And there's actually in your materials a letter from the Healthcare Authority that they provided to the Select Committee addressing some of those issues. And then there are also administrative costs to the Department of Retirement Systems to process these overpayments. So there would be some savings there, but not enough. In the fiscal note last session, those didn't result in any FTE savings. It would just cause DRS to kind of spread that work around to other staff, redistribute their workload. And so here's those budget impact numbers, and this is just for Left 2. And to develop this OSA assumed that deaths would be uniform throughout the month, and that the average member would get a increased benefit of a half month. And so the 25-year cost to Left 2 for the state was $5.4 million, and local government $8.4 million. And then the totals for all of the plans and systems was $82.5 million for the state and $74.4 million for local government. Here's the rate impact for Left 2. It would be 3 basis points for the employee, 2 for the employer, and 1 for the state. And then at the last meeting a couple months ago, there were some questions by the board members about when we were talking about the cost being one of the things that held the bill back last session. There was some discussion of ways where we might be able to limit that cost by looking at some data about kind of how big these overpayments are and only maybe waiving certain overpayments and not others. And so I did work with DRS to gather some data regarding that. And with Left 2 being such a young plan, it's, I guess, good news. Not a lot of Left 2 members are dying right now. And so in the last year, or 2008, there was 37 Left 2 members who passed away. And 9 of those resulted in overpayments related to the month of death. And that average overpayment was around $4,500. But only 1 of those resulted in an overpayment that would have been completely eliminated by this proposal, and that was about $2,000. And so the reason only 1 of those would have been eliminated is the other overpayments all were for more than just that leftover part of the month. They went on to the next month. And we discussed this last time, but often that is caused by people who live out of state, and it takes a while for DRS to gather that data. They've got pretty good data sources for people who pass away in state, but it can take a bit longer for people out of state.
Representative Berquist.
Is there any idea if this number is consistent across retirement systems? I mean, is it at that 10% of these would be changed, or is it, I mean, not that only 10% would be changed, but
that only one would be would
full,
be completely
right.
eliminated. I don't know. I didn't look at the data for all the systems and plans, so I could go back and do that. But
The Select Committee has also heard ideas for potentially reducing the cost, but ultimately they voted to move out the same bill as last year.
I mean, I'm just looking at this information. The initial argument I was hearing was that this would really help cut down the workload. I don't see any cut down of any workload here, and so I'm a little concerned about that.
Now, for Left 2, it was, I think, I can just speak for me, it was different than what I expected to see as well. And that number of, again, it's a small sample size, so we'd want to look into what this does. We expected more members like at the end of the month. DRS isn't going to have a chance to catch that before they do an overpayment. But for members out of state, that was not kind of what we expected. And one of the things, just within all the plans, more than half of the members tend to remain in state, but there is a significant portion of Washington state retirees that are out of state. Anywhere from 25 to 30%, I think, is fairly common.
Steve?
Pat?
Can we back up a slide? What's the total cost over 25 years? Total for all three.
Okay, this left to overall cost.
Sorry.
Was, $82.5 million for state.
$82.5 million.
Yeah, for the state general fund, and 74.4 for local government.
160 million is what it would cost over 25 years?
Yes.
Okay, thank you.
Okay, and so here are the policy options. We have option one is to do the same as last session and endorse to pay the full month of death payment. This is the one that the Select Committee on Pension Policy already endorsed. Option two, I didn't go into any detail about, but this is what Steve alluded to, and I had this on here because it was going to be, it was in the Select Committee's materials, and I didn't know what way they would go when they met last week. But it's for, they had discussed an option where members could purchase the full month of death payment, and so it would be on the member to make a decision at the time of retirement whether they wanted to have their last month benefit be a full month benefit and not leave their survivors in this situation. And so each member would make that election, and they would have to take a small reduction in their benefit in order for their survivor to, or their beneficiaries to not end up in that situation where they're paying back an overpayment. But there was very little discussion of that at Select Committee. But if it was something you're interested in, I could flesh that out for a future presentation. And then option three is just to continue on with the current practice. And that completes my presentation. If you have any questions.
Questions for Jacob? No? All right. Representative.
On the option two, you said you could flesh it out a little bit more, if possible. Like, basically, what would that look like?
So we'd have to work with the actuary's office for them to come up with a reduction that the member would have to take. And so at the time of retirement, similar to when you leave a survivor benefit, you'd have to make an election at that time to take a very small, I haven't talked to them at all about how much this would be, but it'd be a very small reduction in your benefit in order to pay for the beneficiary to get the full month benefit, so there's not an overpayment being collected on that. So I think the fleshing out part would be exactly, how much that reduction would actually be.
So it sounds like, let's say we're looking at 30 out of the 37 deaths, 9 had some kind of refund that they might have not had to refund otherwise. Only 1 was full.
Yeah.
And then we would take a subset of that. Basically, you'd have to look at, okay, how much does that cost over the whole spectrum, and what would that then be as a deduction on the benefit for the month for each person, if they sign up for it?
Yeah, so they'd have to sign up for
Right.
it. Yeah, let's get into the actuarial science part of it as far as how they would price that out, but have not discussed with the actuaries.
Yeah.
I'm not looking for a detail. I was just trying to
No, roughly it would be how much would it cost in a reduction today to get you an extra half a month benefit
Right.
at some point in time in the future. So that would be a fairly small reduction. The SCPP didn't really go into a lot of other options, like why not roll that small amount into the survivor reduction factors or into the current option factors, or make it a mandatory, part of the other than this. But they did move the same bill as last year, and they did say that they wanted to jointly endorse that with the Left 2 board if the Left 2 board wanted to endorse it. If you could endorse it today, or we could bring this back for more discussion for you, including possible endorsement at November or December. That'd be up to your will. Senator?
So, do we know what other pension plans do in other states that are similar to ours? Have we studied that?
So the select committee did look at some other peer states, and I believe that Oregon did pay the full month benefit. There were some other states that paid full month, and there were others like us. It was split.
Ade?
So for last year, we supported option 1.
Yes.
I mean, I think part of our theme say they keep us safe, we keep them secure. I mean, why should we have these people worry about 10 days, 20 days, when they're kind of mourning their spouse? Just think we're trying to talk about how to spend how to enhance the benefit. We want to be nickel and dime when somebody just lost their spouse. About if they are renting an apartment, they will have paid for the apartment. If they are paying for utility, they will pay for the entire month. So I think we should stick with what we did before.
Okay, is there a motion on the table or this policy option?
Policy option, I'd move option 1.
Is there a second?
Second.
In the vein of discussion, I'll open up, is that one of the things that I think that pushing option 1 back on the table is recruitment and retention. And this speaks loudly to recruitment and retention, especially when somebody's dealing with a death. And I think it's, I agree with what Ade said as far as it enhancing the plan and removing a potential worry from a family who's dealing with that. Any other discussion? Pat?
Just one quick one. As I look at option 2, so we're going to ask to see what it would cost for me to die on the first of the month versus gambling that I was going to make the whole month and then lose all that money. It just doesn't make any sense. I mean, risk management, I understand risk management, but so we're telling the guy you got to make, or male or female, what you're betting on is you're going to die if you take option 2, that you're going to die on the first or second day of the month, and that way you'll be able, your spouse will be able to keep the benefit. I think that's crazy. So, and of course we're not in favor of option 3. So the only realistic option we have is exactly what Ade said is option one. It's retention, it's respect for the people that served, and for public service, whether it's police, fire, or PERS, because if we get this, they're going to get it too. So I agree.
Any further discussion? Senator Hawley?
Thanks, Mr. Chair. I'm going to agree with you, but I'm going to take the other side of the equation. So much what we do is based in numbers, in an actual basis, in costs. This is one of those things that presentation or framing an issue is every bit as much important. And I have to say that it would be real interesting what our conversation would be if we had, say, a year ago, somebody had brought this to the attention of the public, or absolutely, gone nuts about this, actually having to pay back after a line of duty death, retirement money's paid out on that. That's one of those, can you believe conversations that just socially present so poorly that the cost on this is de minimis. I think over a 25-year period. Yeah, we have a big dollar amount. Budget impact is about 27.6 over a 25-year period for everybody playing all together. The state employees and members on that. But that's about $1 million a year when you just divide that with the mean averaging on that. And if you talk about, we've got a ramp up in front of us at this point, to where we're actually going to have principal being able to show return on investment before we actually hit that full stride and have the amount of deaths you're going to have for left too. All these things kind of come together. This is really a negligible cost for something that presents so well. And if somebody brought this to the public's attention or actually got press, would present so poorly for us, I don't think we can avoid this.
Thank you, Senator Hawley. Any other discussion? Senator Warnick?
Real quick, logistically, I looked up the bill numbers. 5335 was sponsored by Senator Bailey, and she has resigned from the Senate, so as of the end of this month. So someone else might have to pick that particular bill up. The House bill is still alive as well, but just that's something we'll have to think about when we do, if we move forward with this. And Senator Bailey was one of the biggest advocates for good pension policy in the legislature, so hopefully we can keep that going if that's what we vote on to get it through.
Thank you, Senator Warnick. Any further discussion? Okay. All those in favor of motion of option one?
Aye.
Aye.
Aye. Aye.
All those opposed? Right. With the yeas have it, the motion passes. And thank you, Jacob. Yeah, you gonna move right on the next one?
Yes.
Okay.
One
Plow
down.
through these. Yes. Interrupted military service. This is an issue that the board has heard
Survivor
a
option.
couple of times. And
Survivor option.
oh, I skipped it. Oh, nice try. When I said plow through, yes. So the survivor option election, number 9 is an issue that you've heard before. This is the issue that you were talking about, Pat. With that, though, I'll just turn it over to Jacob for the follow-up.
Okay, the issue here is should members have an opportunity in certain situations to change their survivor option after retirement? And the certain situations that we're going to talk about here are after receiving their first pension payment, or if they're after retirement, if there is a change in their pension benefit. So what is the survivor option? I think we're all aware of this, but just go over it real quickly. Left two members may elect to take a reduction in their monthly benefit in order to leave an ongoing benefit to a survivor. Typically, they do this at retirement. However, there is at least one example where they can do it after retirement, and that is post-retirement marriage, which I'll talk a little bit about more about later. There are 4 survivor options: single life, joint in 100%, joint in 50%, and joint in 2/3%. The purpose of the reduction that a member takes is that they should receive the same amount of money that they would have received if they had not left a survivor benefit. And we'll explain why that's important as I move forward. And I should say the reduction of that survivor benefit is based on the member's age and the survivor that they identify as age. So how does a member know what their benefit will be if they have to make this decision at the time of retirement? How do they have the information they need to make that decision? So DRS encourages members to request a benefit estimate within a year of retirement. They have two options of how they get those estimates. There's an online estimate, which Mark from DRS discussed earlier. You can get in there, you can run all kinds of scenarios, and you can do it as much as you want. And then there's also official estimates that you get from DRS, where you provide them information and they have access to your account and they can run estimates as well. To create an estimate, DRS asks a member their expected retirement date and what survivor option they would like to select. And then the estimate also takes into account their expected final average salary and their total service credit. And like I said, a member can receive as many estimates as they want. And I think a lot of retired members do as they get nearer and nearer retiring. And actually, DRS, this came up in earlier discussions, but DRS does require an estimate. Even in the extreme case of someone quitting their job unexpectedly and driving straight to DRS, they still make them get an estimate before they do move forward with retiring. So if members are relying on those estimates to make this irrevocable decision around a survivor benefit, how accurate are those estimates? And so this chart here, you can see that for the most part, they are very accurate. 93% are within 3%, and it's just 1% of those are more than 10% different from their actual benefit. So common reasons, had a chance to talk with some DRS employees about some of the common reasons for estimates being different, and those included members selecting a different survivor option for their estimate than they get in their actual benefit, members retiring at a different date than they expected. I think typically that's moving it up, thinking they're going to last a little longer and deciding, no, they've had enough. And then changes to final average salary, which could be an expected pay increase or decrease, or an employer error in reportable compensation. And then also sometimes the incorrect birth date for a survivor when they're filling out their materials. So can a member's benefit change after they retire? So the previous slides were really about at the time of retirement, but then someone's been retired, can that benefit change? So it can. DRS sometimes receives additional information about an employee's final average salary or their service credit, and they recalculate the retiree's benefit. This is referred to as a recalc within DRS. And the current law does not allow a member to change their survivor option after a recalc has occurred. And so these recalcs can often occur, I think we'll get to it in later slides, but we're looking at, a 60, 30, 60, 90-day window. But these recalcs can often occur far outside of that window. They can be the result of audit or various other reasons that this information would come in late to DRS. And a recalc can be good or bad news. It can increase or decrease a member's benefit. But even if it increases their benefit, they might want to change their survivor option if they could. So some data about the recalcs that DRS does. This is from last fiscal year. There were 256 Left 2 recalcs. The majority of those were a change of less than 1%. However, there were 10% that were more than, or 18 of those were more than 10% change in their benefit. And as I said before, those can result in an increase or decrease, and the majority are an increase, but 18% of those did result in a decrease to a member's benefit. Once again, kind of going to when you're making policy decisions around this, where that window should be, how long the window should be to possibly change their survivor option. This is the data around the timeliness of DRS recalcs. The majority of them are done within 90 days, 67%. However, there are 20% that are more than 180 days. And from just speaking with DRS about it, there are many of those cases that are over 180 days can be far over 180 days. Once again, going to DRS has a pretty small audit team that gets out to employers, does these audits, and then that can cause changes far after 180 days. So why can't a member change their survivor option? One of the policy reasons is it increases the risk of anti-selection. And so anti-selection is the tendency of a person to recognize his or her health status in selecting the option which is most favorable to him or herself. So the more opportunity a member has to change that election, the more likely anti-selection will impact Left 2. And that's because the more time they have to change that selection, the more time they have to gather data about their health than they would at the time of retirement, which could impact whether they choose to leave a survivor option or not. How the risk of anti-selection is currently mitigated through making members make that survivor option election at the time of retirement. And then also I mentioned earlier that there is the post-retirement option to change. If someone gets married after retiring, they can select a survivor option. And so there's a window created around that so that someone doesn't have a shotgun wedding for the sake of leaving a survivor option to someone. You have to wait a year after getting married to leave a survivor option, and then you have to make that decision before you've been married for 2 years. So they have this 1-year window to make that decision, which helps mitigate any anti-selection risk.
So excuse me, Jacob. So for that, the window for post-retirement, if a left retiree, say, retires today, a year from now, the spouse passes away. So of course today, that retiree will have selected the spouse. So a year after the spouse passes away, that retiree remarries. So is that new spouse covered or not covered?
No, they would not be covered initially. So it's called the pop-up provision. So that member had selected a survivor option, their spouse passes away, their benefit pops up to as if they had selected to leave no survivor benefit. So they start receiving their full benefit, and then if they remarry, it goes into that window. They have to be remarried for a year, and then the window opens to have 1 more year. Okay, so how could anti-selection impact Left 2? Why are we concerned with this risk? So it could increase contribution rates, end up creating less favorable administrative factors for survivor options, and so you would have to take a larger reduction in benefit to leave a survivor benefit. And then also there's a risk of intergenerational inequity, which is one of the funding goals of the Left 2 board to avoid that. And that would be that members today receive more money than OSA than was assumed they would receive. And then the next generation gets stuck with the bill for that. So we did look at other pension systems, and Oregon was the one who got the best data from. They have a 60-day window for retirees. 60 days after receipt of their first pension payment, they can change their survivor option. As you can see, 0.7% of new retirees took that opportunity to change their survivor option. And when I talked to them, I asked them, whether they had any idea what the administrative cost was of that, and they said, no, it's negligible. It's such a small number of people who take advantage of that. And so policy options here, the first policy option would be a window for all Left 2 members at the time of retirement. So after the receipt of their first payment, they would have a window of, and I put a few options here, of 60 days, 90 days, or 120 days to change. And the second option would be a qualifying event window, and so this would cover those situations like an audit where something happens months after you've retired. There's a change in your benefit. Should they have an opportunity to change their survivor election at that time? And there could be parameters put on that any change should qualify for them to have a window to change that, or only changes meeting a certain threshold. And so I put a couple options here of 5% or 10% change in their benefit would give them the opportunity to change their survivor option. And then policy option 3, this would be something if you're really concerned about anti-selection risk. It was an idea first floated out to me by the actuary's office. They're probably regretting it now that they keep seeing it again and again in these presentations. Yeah, if you're really concerned about anti-selection and the kind of perception of people taking advantage of a change in their benefit to make a change in their survivor option, that really is more about regretting what they chose and not about the change in their benefit. This would limit it so that they can only select a larger survivor benefit if there was an increase in their benefit due to a recalculation, and that they could choose a decrease, a smaller survivor option if there was a decrease in their benefit. So that's another option. And then last, a combination of any of those options, as far as if you want a initial window at the time of retirement, and then another window if there's a qualifying event. So those would be additional options. That concludes my presentations. If there's any questions.
I have a question for you, Jacob. So what I'm trying to quantify is, based on the statistics, granted it's from Oregon, if we were to make an assumption that we would have something similar, wouldn't that be very close to what the numbers are when on the annual recalculations that DRS does?
I hadn't looked at that.
It looks like it could be pretty close.
By close, you mean that most of the recalcs are done within 60 days, which is what Oregon uses as their...
Correct. And the numbers seem to be fairly close.
That's what I thought. Were you meaning that the number of people who have a recalc is similar to the number that chose to change it?
It seems very close.
Yeah, there were 256 left to retirees who had a recalc. Like I said, the vast majority was less than 1% change. The 158 were just 1%. And then it was 98 who had a change of 1% or more. Yeah. And then it was within 90 days, 67% of the recalcs were done by DRS. So they were able to get those recalcs done. And I know they make an effort to identify and prioritize the recalcs that have a larger amount. They've developed ways to help identify when those are more likely.
Representative Berquist.
So on a recalc, would then that restart this 60, 90, or 120-day window, or how do you envision that?
So that's something we'd have to identify, and yes, I think that would make sense for people to have that recalc, be aware that there's been this change in their benefit, and to have some sort of window starting at that point. Whether that's 30 days after that point, but there had to be something identified as far as a time frame for them to make that new decision about selecting a survivor option.
Yeah, sometimes we tend to envision that retirement will be very smooth. You'll get your first check, and it's going to be exactly the same amount every month thereafter, except you get your COLAs. And what reality is that not the case. So Jacob talked, we get extra data comes in from the employer, and that gets adjusted. And then perhaps even years later, more data comes in from the employer because of an audit or a contract that's been ratified with retroactive salary changes. And your pension payment changes again. Sometimes we've had, for instance, if you have a property division order on your account, that can confuse that initial payment. I know in the case of the member that contacted Pat about this issue over a year ago, that was one of the complicating factors. So their pension payment was super high the first month because the property division order wasn't applied, and then it was super low the next month because they had to retroactively include the payment that had been missed, and that was 3 or 4 months down the road before that individual's pension payment actually leveled out. And then they were able to see, oh, this is much different from what I expected, and contacted DRS about changing that, only to learn, as Jacob mentioned, that's a one-time irrevocable choice at the time of retirement, and you can't change it.
Stevie, you did a great job explaining exactly why I'd like to see this move with option one, because the person, I mean, I don't think I could say it any better, but one of the other options is that they had, with all due respect to doing the calculations and the estimates and stuff, he thought he had done it correctly. DRS said this is what it's going to be, and then once everything leveled off, the money he got was not where he wanted it to be, and he was arguing with himself on which option, survivor benefit, and he picked the better one, figuring he was going to cover his spouse, and all of a sudden, once the numbers came out, he needed the lower one to be able to survive on retirement. And thank goodness through DRS, it was through the process. He was told no, 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 and then the third or fourth layer, once he got to DRS, they finally said, "You're right," and they corrected it. He was lucky, and having a 60-day window, I'm not sure if somebody that has a cancer or something like that, they're pretty much aware of it before they go, and whether it affects them or not. But I think a 60-day window so everything shakes out. There's been a couple of checks that have changed hands. You know what your insurance is. You know what you're going to get in your hand, and you're right. I mean, when I retired, it was like, okay, I go down to DRS. This is what I'm going to do. You walk through the door, and all of a sudden, you think you've done everything correct, and DRS has done everything possible to ask you the right questions on where you want to be, and you think you've made those selections. Then you get home, and all of a sudden, thank goodness for me, I have a wife that is very astute and knows I'm not that bright. She went back and she says, you got a problem here. And I was able to switch before I got in there, because I would have been in the dummy cat once I got my retirement. So I have an individual that came to me, but I don't know how many of those people are actually out there. And if it's more than one or two, when you're retiring, it's over. You're done. I mean, most of the time, especially trying to figure out that I want to go be a greeter at Walmart is not something that's on my horizon when I retire, but sometimes that might happen. So this is more of the numbers are the numbers, but in reality, human nature and what's the right thing to do for our members is what I'm looking to do. And I don't think 60 days would hurt us. So.
Adi?
Yeah. Jacob, option one includes that there must be spousal consent. So do all the other options have that?
Yeah, I think that they would have to include that, yes. Okay. I didn't bother to write it all out for all the slides, but yes.
Okay.
Representative Berquist?
You were kind of talking about some experiences. It sounds like even one or two checks sometimes doesn't tell the whole story. A 60-day window, basically that's 2 checks, right? You get one check, and then 30 days later you get 2 checks. That 60th day, you might not even have that third check yet.
Yeah, if you were to move forward on this issue, then the trigger for that window should probably be either that if you're going to use the date you receive your first check, I would say probably then maybe 90 days
That's what
after
I'm-
that.
I was feeling
If-
90 days.
Otherwise, if you wanted to say the date that you receive your first check that represents your ongoing amount.
That's hard.
That's hard to put into statute, but then you could do 60 days after that, I think would be more beneficial, like you said, to the member. They'd have a better idea of understanding what's going on.
Could potentially, in a 60-day period, potentially, given, albeit an unusual circumstance, it could be one check.
Yeah, DRS is, their track record of getting those checks on time out at the end of the month is extraordinarily reliable. So, yeah, you're in a 60-day window, you're almost certainly guaranteed to get two. Not from the date of retirement, but the date that you think of as retirement, the date you stop working, but the date you get your first, your retirement date is the first of the next month. Using that retirement date, you're going to get two checks in 60 days.
I should add, too, I did have a member come up to me after I spoke about this issue at the Select Committee and raised a concern that sometimes members have a trip planned when they retire. It's a big deal. They might be out of state and not following this as closely as they would be. And so he had expressed an interest in the window being 90 days or longer for people in that situation.
Yeah, Jacob and I have both had the unpleasant experience of being the manager of DRS's Legal and Legislative Services Unit. So we both had the personal experience of explaining to some of these members what it means when you make an irrevocable decision at the time of retirement. It means you can't change it. And yes, whether it's the teacher who I had a teacher who made their election and then found out they couldn't actually retire. They ended up 1 month short on service credit, and they were on a cruise celebrating their retirement. So they couldn't do anything about it, and apparently their partying with their school district was less than pleasant. They said a few good things on their way out the door, and so returning to employment for another month was also not an option. So all of these kind of, anything that you can imagine surrounding these events comes up, whether it's misunderstanding about whether taxes are included, even though DRS is clear, your estimates do not take into account your taxes. That comes up. A lot of members, despite DRS's advice to get an estimate within 1 year of retirement, they don't. And so they get their first estimate a lot of times in a month, or sometimes literally at the appointment where they're filling out their paperwork to retire. And so to some extent they've limited their own ability to make an informed choice, but nevertheless, then consequences flow from that as well. If you're DRS and you only get 1 hour to explain to a member all of the choices that they need to make and all of the pros and cons, then there's a greater likelihood that the member is going to regret some of the choices that they make, or maybe that they won't understand some of the choices that they're making at that time. So this issue is one that if you're interested in continuing, again, the Select Committee does not have this on their interim work plan. This is something where we could flesh out these options a little bit more for you for a possible final presentation at November or December. That would take a motion.
I'll make a motion to move it to November. My greatest concern here is like some more data. There just seems a lot of areas in here. I'm in support of it. I like it, but I'm concerned with, as always, unintended consequences. And I don't see glaring obvious ones, but I want to be sure that we've covered all our bases given our responsibility of the plan. I'd make a motion to push it to November.
Just discussion.
Discussion, yeah.
I really would like to maybe know a little bit more about those. It says 3 to 10% kind of in that category, but then we're talking about 5% or 10% in this. I was hoping we can maybe get a few more details on who is that 5%, and also if you can dial it down to out of anybody 5% or more affected, how many are positive, how many are negative?
Yeah, we'll try to dig into that data a little bit more, and if we don't have it ready for November, it'll be December.
The other piece is like how much risk does this take away if we do this policy option 3 language as well? Kind of want to understand what the difference is between have that choice or really lack of choice.
Any other discussion?
Tracking.
Okay, so we had a second. Discussion's over. Okay. All those in favor? Aye. Hear from the folks on the phone. All those opposed? All right, thank you. The motion's carried. And with that, I need to get going. I need to get on the road. So I'm going to be passing the gavel to Ade.
Next up on the agenda is item number 10, interrupted military service credit. This is an issue that the board has heard about during the interim. This was also an issue that was communicated to the Select Committee on Pension Policy for possible coordination, but it is not currently on their interim work plan. And with that, I'll turn it over to Jacob.
Okay, so the issue here is that the definition for qualifying for no-cost interruptive military service credit is written in a way that requires it to be continually updated for veterans' military service to be treated in a uniform and fair manner. And those of you who've been on the board a while know that because you've seen this topic in front of you many times. So interruptive military service is defined as the member leaves public employment to serve in uniformed services. The service is honorable, and then the member returns to public employment upon completion of their service. There's 2 types of service credit that military members qualify for. There is fully subsidized, which is known as no-cost interruptive military service credit. And that's what this presentation is going to be focused on. But there is also partially subsidized service credit, and that is what qualifies for that is any interruptive military service credit that doesn't meet the threshold of the fully subsidized service credit. And on the difference between the two, the partially subsidized, the member pays the member and employer contributions, but they're not charged interest on those payments. So the Left 2 board and the Select Committee endorsed 2009 legislation which created this benefit, the no-cost interruptive military service credit benefit. And under that legislation, the member must meet the definition of veteran under the separate RCW. And that RCW is not actually in the pension statutes, it's in the personnel statutes. And so it's more than just retirement that uses that definition. It's used for some additional benefits as well outside of pensions. And so in that definition, it defines veteran, and the part of that definition that we want to focus on is the second bullet point under there, the specified military operations. And so within that RCW, there is a laundry list of military operations that have been specified, and this has been updated. So that part, the benefit was passed in 2009, but that separate definition of veteran was actually passed in 1969. And I went back and looked through the legislative history of it, and it's been updated more than a dozen times since then, and most of those have been adding additional wars or military operations to the RCW. The Department of Defense awards a campaign badge, and so the other part of that definition is the military operation, and then that it has earned a campaign badge or medal. And so the Department of Defense awards a campaign badge or medal to service members who served during a specified conflict and were stationed in a designated war zone. I look back at the 2008 and 2009 record of when the Left 2 Board and Select Committee were considering this legislation and then eventually endorsed it. And it seems as if they both settled really quickly on using this veteran definition, and there were no other definitions considered at that time. Here were some of the, I put together a table here of some of the policy considerations in 2009, and this is taken from both Left 2 Board materials and Select Committee materials at that time. So if you were kind of curious to see what was considered at that time as for reasons not to create the no-cost interruptive military service credit benefit, and then on the right side there to have that benefit. And I thought this may be helpful to you if you consider one of the things we'll talk about in this presentation briefly is that there has been some push in recent years to expand the no-cost interruptive military service credit benefit to include service beyond a campaign badge or medal. And I'll get into more detail about that. So some background information on the different categories of medals. The eligibility for a medal is based on a service member's degree of personal risk, which is their proximity to the enemy, service in a combat zone, imminent threat of hostilities, the degree of personal hardship, which by that they look to the deployment to a designated area of eligibility and participation in a designated military operation, and then also the extent of military service during specified time periods, duration, or types of duty. And so campaign medal, as I showed earlier, that's where the line is drawn currently for meeting that definition of veteran and qualifying for this benefit. And then the next level down is expeditionary medal, and that is the level that has been brought up in recent legislative sessions. There's been some discussion of whether to extend to that level or not. One issue with that is there's not a data set out there that us, DRS, state actuaries have been looking and unable to find a reliable data set there that would show us what the potential cost of that is by identifying how many public employees out there would qualify if this was expanded to expeditionary medal. And the number of service members who qualify for that, I don't have the specific number that get a campaign medal and the specific number that get expeditionary medal, but it's clear from looking through what qualifies for the two that it would be a large increase, especially since 9/11, the global war on terror is an expeditionary medal that is awarded for a lot of service since then. So potentially this could have a large increase in who qualifies for the benefit. And then there was also the deployed service medal, and the difference with this one, the main difference is that people who qualify for this, it's a designated military operation where there's no foreign armed opposition or imminent threat of hostile action. And then there are also individual service medals, and this includes things like a POW medal. So you would think there would be a really nice collection somewhere with the Department of Defense or some federal agency of all of the medals, all of the different campaign medals, expeditionary medals that have been given out over time. I have been unable to find that. I've worked with State Actuary's Office, Department of Military, Veterans Affairs, and every time we think we have found something, we have so far not. And so that is one of the issues that has caused this RCW to continue to need to be updated over the years is policy, legislative staff, boards think they have identified all of the medals, and then it is brought to our attention that we have missed one. And And so that is one of the ongoing issues causing to be updated. This is one of the best lists I have found of, it's in some DoD materials, it's recent examples of these medals. And on here was where we identified that there is one, the Kosovo campaign medal, that is currently not in RCW. In talking to DRS, they have not had anyone come forward to them with this medal who's been denied no-cost interruptive military service credit, but still is an oversight. It's not in the current law, and there's no way of knowing if there are people who have not applied because they have not seen, they have looked at the law and saw that this is not listed. Hopefully there's no one that falls in that category, but there's no way to know. Just some recent legislative history. Like I said, those of you who've been on the board a while have seen this topic before and have endorsed legislation. And the most recent legislation the board endorsed was House Bill 2071 in 2018. And this made a few changes to the bill. It added, put an end date to the Gulf War, added some additional operations like we were discussing, listed there, and then made some other, just some administrative cleanup issues to make sure it was in law. So why are we already looking at this law again? Once again, the state veteran definition specifies these individual military conflicts and designated war zones, meaning that each time there's a new one or one is missed, it needs to be added to keep the policy consistent. The definition is, like I said, definition is located in the general personnel statute, not pension statutes, meaning that when it updates, it could potentially impact more than just pensions. And so that may be something that the board wants to look at, is whether to go ahead and move this definition to the pension statutes to ensure that it's, if there's going to be kind of major structural changes made to how it's defined, that it's only impacting the pension. Touched on the first one there. Also, the Department of Defense periodically upscales medals for campaigns, meaning that a campaign would have only qualified for, say, an expeditionary medal, and then they make a change to that and have military service members reapply, and they may qualify for a higher level campaign medal. And so, and that has happened recently. So policy options here, the board could choose to move the definition of veteran to the pension statutes and rewrite it to include all past and future armed conflicts where campaign badges are awarded. So by that I mean, instead of limiting it to a list of specific military operations that qualify for a campaign badge, it could instead be written to just require that you have received a campaign badge. And that way it doesn't need to be updated each time there's a upscaling or a new campaign that qualifies for that badge. Option 2 would be the same as option 1, plus it could be expanded to include expeditionary medals, campaigns that are awarded expeditionary medals. Option 3 would be keep it where it is and update the list to include any new armed conflicts. The one we've identified so far being Kosovo, and we'd continue to work with our partners to make sure that we've hopefully identified all of them this time. And then option 4 would be no changes to the existing law. And that concludes my presentation. If there's any questions?
So, hello, this is Mark. Can you hear me?
Yes.
Oh, good. Okay. Trying to get back on. I've been here, but haven't been able to respond. So, Mr. Chair, I'd like to make a motion.
Go ahead.
Sure, I'd like to make a motion to option 2 on interrupted military service credit.
Motion has been made. Any second?
I'll second. This is Dennis.
Any discussion? Any other discussion? All in favor say aye. Aye. Opposed?
Aye. Aye. Aye.
Motion
Aye.
carried. Moving on to item number 11.
Item 11, PEB coverage for catastrophic retirees. This is this issue was discussed a little bit the interim before last, and then tabled for this, to bring it back this interim. With that, I will turn it over to Jacob to follow up on the earlier presentation.
Okay, last one. So the issue here is that Left Plan 2 catastrophic disability retirees and their survivors have different medical insurance access than survivors of members killed in the line of duty. Specifically, that access is access to PEB. So this issue was brought to the board by catastrophic disability members as a possible solution to issues they have experienced with accessing affordable health insurance coverage. And by DRS, because they work closely with the catastrophic retirees and try to help them through those issues. And it's also administratively more difficult for DRS to work with this diverse and shifting field of individual providers instead of just working with PEB like they do for survivors of members killed in the line of duty. So what health insurance benefits do line of duty death survivors qualify for? Since 2001, they've received coverage through PEB. And I should say PEB is the Public Employees Benefit Board, which is run by the State Healthcare Authority. And they purchase and coordinate insurance benefit to eligible public employees and retirees. And so under the 2001 legislation, the cost of the insurance was paid by the survivor. So they had access to PEB, but they still had to pay for the insurance. And then in 2006, the Left 2 board passed legislation which has reimbursed those PEB premiums for those survivors. And the main advantages of PEB is that it typically costs less and provides better coverage than survivors and members would be able to find out on the open market. So what healthcare coverage do catastrophic disability retirees have access to? They have access to COBRA, which is a federal benefit, and it's temporary in nature, only 18 months of coverage. And the amount that a member receives under COBRA is different depending on their employer. And then some people have access to employer-provided coverage. And then and some of them that have access to that also have access to PEB through their employer. And then others are subject to, after their 18 months of COBRA coverage is gone, they have to find coverage in the open market or through the state's health benefit exchange. Since 2006, catastrophic disability retirees' health insurance premiums have been reimbursed by Left 2. So they not have access to PEB, but their premiums are reimbursed up to the amount that they were eligible for under COBRA. So this was considered in 2009 legislation to give the catastrophic disability retirees access to PEB. The cost of that at that time was $1.5 million for the first biennium and $4.7 for the second. Those costs are for what's called the implicit cost of adding these Left 2 members to the existing PEB pool, not the explicit cost of actually paying the premiums, which are already covered by the previous legislation in 2006. So that implicit cost is driven by the fact that catastrophic retirees are more expensive than the average PEB pool member which makes sense. They're catastrophically disabled. Their health insurance is going to cost more. However, there were some assumptions in this cost that we have reason to believe would change the cost if it was done today. And the main one of those is the assumed rate of catastrophic retirees. In 2009, the catastrophic benefit was new, and there was an assumption that there would be 14 catastrophic retirees a year, but now that's had time to play out, and the actual experience has been 3.9 a year, and in the last Dexter that the state actuaries did, the demographic study that the state actuary did, they identified a current experience study rate of 4.5 a year, and so they're, as they presented earlier today, they're working on an updated demographic study, but just talking to them, they don't expect that to change drastically. It's higher than the experience, obviously, but with some recent changes in the law, they expect that the experience will continue to trend up slightly over time. So that should drive down the expected cost of that legislation. So policy considerations, some of the pros of this benefit would be that PEB provides less expensive healthcare coverage than typically available through the private healthcare market. All catastrophic retirees would have the same healthcare coverage, and it would simplify the process for both them and DRS of finding and being reimbursed for healthcare coverage. And then some of the cons are some catastrophic retirees are happy with the healthcare coverage they have and would prefer to keep that over PEB. And then the obvious one of it would be an additional cost to the system to provide this benefit. And that concludes my presentation. If there's any questions.
Jacob, since the cost estimate were from 2009, do you think maybe the recent cost information will be available soon? That maybe instead of making decision today, we can delay that till maybe November. By that time, there will be more information.
So typically we would not get, I think we'd have to work with the healthcare authority and with the state actuary's office to get a fiscal note. And so typically they would want a bill proposed by us, but we could work with them to just use the 2009 bill and provide an updated cost. I'm looking at Steve to see if that is something we could do.
Yeah, we could have that for you for December.
Do we need a motion to move it to November?
No, if you wanted to, if you wanted to follow up with cost information for December, that would be appropriate for a motion.
Thank you, Mr. Chair. More from a structural aspect here. You say that catastrophic health care coverage would be more expensive because of the nature of what they present for the cost of medical care. Insurance by nature is socialization of costs to where you actually risk pool over a large body out there. And so the fact that it has to be more expensive by nature of the degree of injury is curious. Are there any current sideboards or parameters on the insurance that we reimburse? In other words, can they pick the gilded policies they want out there that would be the lowest cost to them, and yet we would assume more of a cost to them, say that we would relative to, say, for example, survivors out there?
Yeah, so my understanding is that they get reimbursed up to what they would have qualified under COBRA, and so if they choose something more expensive, then we go up to what the COBRA cost was, and if they choose something less, then we just pay to whatever that lower amount was. And those are the parameters I'm aware of.
Well, just currently, a casual conversation, where does the cost of COBRA for this type of a coverage index relative to PEB right now?
Higher.
How much higher?
Yep.
Maybe as much as up to 25% higher in some cases.
Is even though, and I understand private market out there, the difference is there's a profit margin, some of the other things out there that's required to be in business. can we at least explore the idea, is there a dramatic difference in coverage available through some of these private, not cost, but coverage available through some of these, the other private insurers out there that PEB does not offer? Or is it simply just a different vendor providing a different price structure, maybe with enhanced benefits?
Yeah, no, what we've heard from the catastrophic retirees is you might think that they've got all kinds of shopping options, different levels of benefits, and then they would pick the best one that they could afford, that they would get for free. Typically what's happening, though, is in their geographic areas, there's limited number of choices. And so that was part, and in fact, finding any vendor, if you will, can be challenging for some of them, particularly if they're out of state. So PEB, because PEB's nationwide, helps with that search piece, and then they know they've at least got one option that they can go to. But some of the ones, particularly local, like if you say you retired out of the city of Seattle and you continued on in the city of Seattle's medical plan, most of them can consider their plan superior to PEB, and so they would see they would see moving to PEB as somehow a diminishment of what they currently have.
Is there the potential for a win-win here in that we'd be able to control costs by maintaining within PEB, or at least project costs out there, and the availability that would be provided to members out there, not just individuals out there that have maybe a difference in coverage to their benefit, but the downside on a ratio of total members that are drawing killed in the line of duty and catastrophic, what would you consider the ratio of benefit versus the people would be at a disadvantage?
For most members, I would say PEB is at least equal to, if not better than, what they currently have. And again, this is just me, casual conversation.
Correct.
But I would guess maybe 20% of the catastrophic retirees are in a plan where the benefits are superior to PEB. PEB's not a Cadillac plan, but PEB's a pretty solid, well-designed plan.
And I'd put out there, I guess, as a conclusion that this is every bit as much of a policy decision as it is a cost.
Yes.
It's about cost-based decision here.
Yes.
Actually, can that be part of what, if we can extend the research to provide some of that information at December, that will probably give us more data to make informed decisions.
I don't know if we'll have that specific data, but yes, we can, yep.
So the Department of Retirement Systems has been very helpful in me preparing for this, and so I can work with them to gather more information about kind of what specifically is being reimbursed right now from members, and if they have any anecdotal information too, as far as where members are having trouble finding any coverage. And
I swear, it's kind of a flow here. So a lot of times you'll find that you'll have different entities out there siloed on this, and the buckets of money, come from different sources out there. So there might be some competition for the funding for one purpose, versus private versus actually PEB money. Can you also look into that a little bit?
Okay. So, hi, this is Mark. Can I make just a comment?
Yes,
Can you
please
hear
do.
me?
Yes, we can hear you, Mark. Go ahead.
Oh, okay. Just a quick comment on this. There's a tremendous level of difference in the richness of benefits and the cost for every different employer. So if part of the issue we're talking about here is what we're going to pay based on the benefit structure of that particular employer, there's a huge differential between fire districts, municipalities, and what they pay for insurance and what the benefit levels are for those insurance. So I think it's a huge issue, and I really would support just a little bit more study and a very considered approach to this, because everybody's needs are different. Even if you're catastrophically retired, disability retirement, there are still very different benefit levels and specific coverage under different plans. So I would support a little bit more study and a very considered approach to this position, because I think it's really, really important from a cost point and from a benefit point in terms of what benefit levels people are receiving. So you could have the people with the same injury set who are gaining much different levels of coverage and cost depending upon where their previous employers were.
Yeah, thank you.
That's it.
Shall we entertain a motion to move this to December?
Yeah, I'll make that motion.
Second.
Any further discussion? All in favor, say aye.
Aye.
Opposed?
Aye.
Aye.
Motion carried.
Thank you.
Number 12, benefit improvement.
All right, let me move around on this one. All right, this is a follow-up to the discussion that we had in July regarding the benefit improvement account. To kind of bring you up to speed on where things sit. The past session, the legislature transferred $300 million from the Left 2 fund into the Left 2 benefit improvement account, which is a sub-account of the benefit, is a sub-account of Left Plan 2. Prior to that transfer, there was already a little over $21 million in the benefit improvement account from prior legislation. And so the question before the board now is, what benefit what are you going to spend the money on? Roughly $320 million. What are you going to spend it on? Now, at the last meeting, I mentioned that its issue was coming before you. Nothing in creating the benefit improvement account and nothing in those two transfers provided any direction about what the money was going to be spent for, other than it's a means of funding benefit improvements. That's it. There's nothing specific about the type of improvement. Now, there are some limits, though, on what the money. So, for instance, any new benefit improvement is going to take legislation. So, the board will be recommending what the money could be spent on, but ultimately it's going to take a bill that's going to have to be passed by the legislature before the benefits in the plan change. Secondly, the way the benefit improvement account was set up, the language in there provides that the transfer of the from the account has to be sufficient to offset the full expected cost of the benefit improvement. And so if I can use an analogy here, you are used to, the actuary's office uses the analogy of a house when they're talking about a pension plan, and it's very helpful. And so thinking of a house, you make a monthly mortgage payment, and that's how you pay off your house over time. Similarly, in Left 2, you pay off the expected benefits over time by making the monthly contributions. And so, but if you happen to, you wanted to buy a $300,000 house and you had $300,000 in cash, You could buy the house without making any mortgage payments. And that's what the benefit improvement account, that's the way it's intended to work. So you would buy the benefit by making a one-time payment as opposed to increasing your monthly cost. So that, the size of the money that's available, the $320 million, limits what kind of benefit improvement you can afford to buy. And the actuary will be providing the costs on that. Now, we've been working, the board has been working with OSA over the past year and a half to get current pricing for many of the frequently requested benefit improvements. Ade mentioned earlier, he'd heard from members who were interested in increasing the 2% multiplier. At times at conferences or in communications to the board, members have suggested reducing or eliminating the survivor benefit reduction, changing the final average salary period, and early retirement. Medical is also one that the board has priced in the past, and we're working on getting a current estimated cost from that. And one thing I want to make clear, though, is medical is the medical that we're talking about is not paying for the members' medical. It's just making sure that they all have access to medical, say, for instance, through PEB. That was what was priced before. So if you retired out of Left Plan 2 at age 53 and you're looking for insurance until you reach Medicare age, you could get it through PEB, guaranteed. That was the kind of proposal. Not that whatever your premium would be for that medical insurance, that would somehow be reduced or offset. So it was just purely the cost of medical access. Now, as you've looked over time, you know, I just talked about 5 different areas, and within each one of those areas, there are multiple variations. Changing the multiplier, do you change it from 2 to 2.1 or 2.5 or 3 is frequently requested? Do you do it prospectively or retroactively? Do you do it for only a limited period, not for every year of service, but just for certain years? All of those have been considered and priced. But rather than focusing on a particular benefit, looking at, I compared it, it'd be like looking at the menu at the Cheesecake Factory, where they have 18 pages and hundreds of items that you can choose from. That before you start looking at the menu, go in there with some goals in mind. And at the July meeting, I gave a handout which kind of identified some possible policy goals that you might consider and how those different goals might lead to different types of benefits. And so, for instance, and that handout from July is in your materials. Again, for this, the 3 different examples that I used are just common. These are policy issues that have come from different areas. For instance, recruiting or retaining desired employees. That's generally considered the purpose for employers offering a pension plan in the first place, is it helps them get the kind of employees that they want and keep them. And so if you were looking for a benefit improvement that would improve the ability of Left Plan 2 to recruit or retain desired employees, then you might see a benefit improvement along the lines of a multiplier that applies to a band of service from 15 to 25. So somebody who's been on the job for 15 years, has that experience, has that training, they're a valuable employee, you want to keep them, you increase the multiplier for their next 10 years as a way of incentivizing them to remain for those additional 10 years. That would be an example. When the benefit improvement account was created in the first place. The legislature included a statement of intent, which included that the reason for creating the benefit improvement account was recognizing the fact that Left 2 members have shorter working careers. And if you, for instance, have a 25-year career, which would be considered a long, healthy career in Left 2, at a 2% multiplier, that's still only going to get you 50% of your final average salary. And most retirement experts will tell you that at a minimum, you need about 60% of your pre-retirement income when you're going into retirement. And a good chunk of Left 2 members don't have Social Security, so their pension is their source of retirement. Again, that if that is your goal, is recognizing that Left 2 members have shorter working careers, then you might be, again, be looking at a multiplier, but in this case, the multiplier might be more broader. It would apply to all years of service. It wouldn't just be targeted to a certain core members or certain experienced band of members that you particularly want to target. It would just be in general. It would be a smaller multiply, or it would have to be a smaller increase again to stay within the budget, but it would apply to potentially to all years of service. Now, both 1 and 2 also would probably only apply to active members. So for instance, if your policy goal is recruiting or retaining employees, retirees, providing a benefit to retirees doesn't do anything to recruit or retain. Where retirees come in tends to be in issue number 3. So when, or policy goal number 3, when the legislature created the benefit improvement account, the funding mechanism that was written into the account was that it would be a transfer from the state general fund. In reality, there never were any transfers from the state general fund into the benefit improvement account. All of the $316 million that was transferred in from the Left Plan 2 account. And all members contributed to Left Plan 2, including members who might currently be retired. So one issue that's been suggested then, that a benefit provided from the account, maybe out of fairness, should recognize the source of those contributions, and it should be retroactive in the sense that it includes past service and it includes retirees. If you land on fairness as the goal that you're trying to accomplish, then fair is very subjective. It's very hard to define. One possibility would be everybody gets the same dollar amount. So retirees, active members, they'd all get the same dollar amount. You divide up the $320 million equally. They'd get it as a check or perhaps as a transfer if they're active. They'd get it as a transfer into their deferred compensation accounts, something along those lines. The mechanics would have to be worked out, but then everybody is getting the same dollar amount. Even that, some might not consider fair. Like, well, wait a minute, I was in for 30 years and I should get 30 times the amount of the guy who's only been in the system so far for 1 year. So even if you land on fairness, there's going to be a challenge defining kind of what type of benefit improvement would be fair. But it becomes very difficult to use a defined benefit change if fairness is your goal, because retirees are going to start receiving it next month in their next check. And active members aren't going to start receiving it until they retire. If they're close to retirement, that might only be a year or two in their future. But if they just started it, they might not receive anything for 20 years. And so in the sense of how much of that 320 million, then all of a sudden 80%, for instance, of the dollars might be going to members who are already retired or are going to be retired in the next year or so. Those would be the types of things that would come into play where we would have to do additional research, bring you back specific options. But at least to start narrowing down the menu and making it possible to bring you back some options, those kind of thinking about those policy goals. Now, all of the member stakeholder groups have decided to begin kind of that initial process. And so the WACOPS and State Council of Firefighters and Compass and Fraternal Order of Police all got together and did a survey of their members and asked them kind of what they thought about the goals for the benefit improvement account. They also tried to get some demographic information so that they could get a feel for which option is being preferred by younger members, which option is being preferred by retired members. What for the board, now the results of that survey aren't available yet, but for the board, the kind of a discussion of the goals for the benefit improvement account, a follow-up to that initial document in July, and what I've talked about here today, that would be one of the things we could talk about in October. What policy goals are you hoping to accomplish? Sometime, hopefully before the end of the year, we hope to get updated costs on the healthcare access pricing, and then there could be potential presentations on that in November or December. But the next step would be talking with you again about some of the policy issues. At this point in time, I think it's fair to say there's no expectation. The legislature, when they transfer the money, did not set any date by which they expect the Left 2 board to report back. The member groups that have started this dialogue with their membership to figure out what their preferences are, I don't think they also, there's any expectation on their part that they're going to reach agreement or consensus or have it sorted out in time for this session. So this is a topic that's likely to continue on into the next interim. But with that, I'd be happy to answer any questions about that, the one-page document that was handed out or anything that was discussed today, or if there's anything in particular that you want us to focus on in October.
Steve, I'm just curious, is rate reduction or contribution reduction consider, part of this benefit enhancement? Because if all these employees or, left the state, the employer, have contributed to the fund that where the 320 was taken and reducing the premium the employees are paying, is that considered a benefit enhancement?
It was, that would be one of the things that we could definitely put on the menu. That would not, that would be the type of benefit that would fit more into category 2, probably. Maybe it would be the recruiting or retaining category 1. It would definitely not apply to retirees. So it wouldn't be something that would be fit into category 3 because
they're no longer contributing.
They're no longer, yes, that's exactly right.
Other questions? Comments? Well, thank you, Steve. So this will be tabled again in November,
Yes, October.
October.
In fact, that's a great segue. The last item on the agenda is the October meeting. And so we've got, again, this will be typically a strategic planning type of meeting. There'll be some strategic topics that you have already told us you want to talk about. Your, education policy, your attendance policy, benefit improvement account, update on the results of all of the expectation interviews that have gone on. Those are the types of topics that you'll be discussing. But we did have some practical kind of administrative questions to ask you as well. There has been a difference of opinion amongst boards in the past about when do you want to start. So for instance, sometimes the board will be like, let's start at 8:30, we'll get an earlier start and we'll get done sooner. Or, well, no, let's leave the same start time as 9:30 because that makes it, doesn't make it more difficult on those members who are traveling to get to the board meeting, whereas an 8:30 start time might make it more difficult. So we wanted to kind of get your input, if you would, about, because typically the tentative plan is to start the meeting at the exact same time, 9:30. There would be some breakfast or light food there available earlier. So if you wanted to show up at 8:30 and you were to meet with other board members or have questions before things get going, there would be sort of a soft time to begin with, but then the actual meeting piece of it would begin at 9:30, your typical time. That was our tentative plan, but if you wanted to adjust that, we thought let's give you guys the opportunity to tell us whether you think that works or not. Okay, we'll go with the Senator.
It doesn't really matter on time, but is there going to be a call-in option for that meeting, since it's going to be off-site?
Historically, no. Our technology is always limited when we go off-site, and so I don't think there will be a call-in option. If I'm wrong about that, I will let you know.
Okay, because I doubt I'll be able to physically make that meeting.
Any other comments?
Okay, then we'll plan on the 9:30 start time, same as normal, but we'll be there earlier, and we'll have breakfast there earlier as well.
Well, thank you, Steve. Is there any other item for discussion for this meeting? Why is the meeting adjourned? Thank you.